This hearing of the Congressional Oversight Panel is called to order. I thank you all for joining us today. My name is Damon Silvers, and I serve as Deputy Chair of the Congressional Oversight Panel. The panel's chair, Professor Elizabeth Warren, was called to testify before the Senate Banking Committee this morning at a hearing on TARP oversight in Washington, D.C. She deeply regrets that she is unable to be here, but we are, after all, the Congressional Oversight Panel. I will now turn the gavel over to my colleague on the panel, New York Banking Superintendent Richard Neiman. Richard serves as the chair of New York Governor Patterson's Halt Abusive Lending Transactions Task Force and is a member of the Multi-State Foreclosure Prevention Working Group. Superintendent Neiman has done extraordinary work in the area of mortgage foreclosure prevention for this panel, including but not limited to his efforts to put this hearing together. And consequently, it seemed appropriate to us for Richard to chair this morning's hearing. Richard, the gavel.
Thank you very much, Damon, for those kind words and also for the opportunity to share today's hearing. Good morning. First I do want to thank and am very grateful to the City of Philadelphia and the National Constitution Center for hosting this hearing of the Congressional Oversight Panel. This city has been hard hit by the foreclosure crisis. Too many Philadelphians know firsthand what it means to have a home taken away. The panel would also like to thank Senators Casey and Specter and Congressman Brady and Fattah and their staffs for helping to plan today's hearing on this important issue. I also want to give a special thanks to Judge Rizzo of the Philadelphia Court for working with the panel staff on the hearing and inviting us to visit the court this afternoon to learn more about its innovative mediation program. The number of families at risk of foreclosures here in Philadelphia and across the country is on the increase. What started as a crisis driven by subprime borrowers with inappropriate products has now spread to include families with traditional mortgages. Even prime borrowers are now losing their homes as a result in the downturn of the economy and the downturn in housing prices and job losses resulting from a recession that few predicted. Today's three panels of witnesses will convey the views of, one, the homeowners who are in jeopardy, two, the lenders and servicers who can modify mortgage terms to keep people in their homes, and three, the government that is implementing and overseeing the programs to facilitate these modifications. Only these three groups of stakeholders working together can we develop affordable and sustainable solutions to the housing crisis, and a greater level of engagement and cooperation is long overdue. I am concerned that the pace of modifications is not keeping pace with the rise in foreclosures. We are also hearing specific concerns from borrowers and housing counselors regarding the responsiveness and the capacity of mortgage servicers, and we will hear much more from them today. To my knowledge, this hearing is the first time that Treasury, Fannie Mae, and Freddie Mac are together in a public forum along with housing advocates and mortgage servicers to discuss the progress of the administration's foreclosure prevention programs. We need to see this crisis from the perspective of those who are facing foreclosures, as well as those who are helping these families through counseling, modifications, and the judicial process. The broad representation that we have here today from the servicing industry is especially critical. Housing counselors and government agencies may design initiatives to help borrowers at risk, but ultimately it is the servicers and lenders who will determine whether these programs succeed. They have the power to decide whether to modify a loan or to pursue a foreclosure. As New York Superintendent of Banks since 2007, when the crisis began, I have seen firsthand that positive results for homeowners can be achieved when the public, private, and nonprofit sectors come together with a common purpose. Foreclosure, as we all know, is in no one's best interest. Now, some procedural issues. Because of the number of witnesses appearing today and the extensive scope of the testimony, we invite each witness to make an opening statement really limited to 5 minutes. All of us have already read your written testimony, so that in the 5-minute time period, I strongly encourage you to highlight those points that best capture your main positions and constructive suggestions for the foreclosure prevention. We need to be strict on our time constraints in order to hear from everyone, so I'll ask that you from time to time to conclude your remarks, particularly when the orange light comes on. We'd like to finish our work before 1 p.m. and allow time for members of the public to share their comments with us as well. So with those opening remarks, I'd now like to turn it over to Commissioner Paul Atkins for remarks.
Thank you very much, and I'd also like to thank Philadelphia for hosting this and the Constitution Center here, and most importantly to all of the witnesses who are appearing today at this hearing, some upon rather short notice. So thank you very much for your efforts in coming here. The issue of foreclosure mitigation and its effectiveness is one of the areas that Congress specifically tasked this particular panel to report on under the Emergency Economic Stabilization Act of 2008. I think it's appropriate for us to review what's being done in this area to help address the large number of foreclosures that the U.S. is experiencing these days. I welcome the opportunity to learn from our panels of witnesses today. This is an area that, like much of what is being done by the U.S. government in the past year, is fraught with moral hazard if poorly implemented. The interest, of course, is in helping those who may be in trouble through an interaction of bad luck, a bad economy, and perhaps bad personal circumstances. If you're out of a job, it is really difficult to make payments unless you've saved over time. But just like that proverbial dichotomy between the ant and the grasshopper, we want to be sure that we're helping the ant and not necessarily the grasshopper. So I'll be interested today to hear how these programs are operating, what steps are being taken to help those who actually deserve it, what measures are built in to root out fraud, and who is actually bearing the costs of these extraordinary measures, in particular the taxpayers and the investors, because I think they deserve to have accountability in this area. Thank you very much.
Mr. Silvers.
Thank you, Richard, and good morning. It's a pleasure to be here in Philadelphia, which is the city where I lived as a child. And I mention this not as an exercise in mere nostalgia, but because we are here to talk about home foreclosures, an event in which banks, servicers, investors, courts, and ultimately officers of the law come together to remove a family from their home, their community, their children from their rooms, and from their schools and their friends. I said this at our hearing in February on this subject, and I will say it again. The fact that a lender can throw a family out of their home is a necessary part of a system of lending, but it is also an act of emotional violence and economic destruction. Foreclosed homes typically yield less than 40 cents on the dollar to lenders while destabilizing neighborhoods. Foreclosure should be the last option after everything else fails. Before I turn to those economic consequences, I just want to say that I still see this issue through the eyes of the 8-year-old I was here on Hamilton Street in Philadelphia, and how I would have felt if we had suddenly been forced out of our house. Public policy should be about minimizing foreclosures for the same reasons it should be about minimizing child abuse or protecting the public health or educating our children. Others may disagree. Some may see no particular reason to view a home foreclosure any differently than any other failed financial transaction. Some may feel that the children should suffer from the sins of the parents. Some may feel that before the government can act to help a family, it should undertake an exhaustive inquiry into that family's morality, business judgment, general character, for fear that some of the money that would otherwise go indiscriminately to the stock and bondholders of our large banks might be tragically and improperly diverted to a less than upstanding homeowner. The remainder of my statement is addressed to those who share one or more of those views. For the reality today is that the continuously escalating mortgage foreclosure crisis threatens to overwhelm the entire effort to stabilize our financial system in the interests of broader economic recovery. This is the intersection of morality and economics. Current estimates from the Mortgage Bankers Association are that so far we've had between 5 and 6 million foreclosures, which sounds big until you recognize that this is less than half of what is projected to occur between now and the end of 2010. This tidal wave appears to be the result of a combination of predatory lending, collapse of underwriting in the bubble, rising unemployment, and the inability of homeowners with negative equity to refinance. This tidal wave threatens a vicious cycle in which foreclosures exert downward pressure on housing prices, falling real estate values and defaulted mortgages push down on bank capital, weakened banks pull back on lending, causing business activity to decline and unemployment to rise, feeding more defaults. This panel takes up the issue of foreclosure prevention, as my colleague Paul Atkins said, a statutorily mandated purpose of both the TARP and this panel, against the continuing mystery of why lenders and processors are unable to renegotiate troubled mortgages at scale when it has long been clear that such restructurings are generally in both parties' interests. Despite the enduring nature of that mystery, two things have changed since our panel held its last focused its hearing on foreclosures. The first is the Obama administration's plan for prevention has been in operation. The second is that the driving force appears to have shifted from predatory loans to unemployment and negative equity. The administration's commitment here to help families is admirable. However, it appears that without addressing these issues of unemployment and negative equity, it may not be effective. I continue to believe there is no way to do this on a national scale without allowing judges to do so in bankruptcy. Finally, the problem of mass foreclosures is the other side of the coin of weak bank balance sheets. So long as we make our policy centered on pretending we have strong banks, we may not be able to admit that these loans have to be written down if we are to end up with viable housing markets and stop the downward spiral. There are, as Superintendent Neiman has said, we have, I think, outstanding examples of innovative approaches here in Philadelphia and Pennsylvania. The program Judge Rizzo has been leading, the HEMAP program at the state level, I think is a large part of why we are here today. We have an outstanding set of panels, and hopefully it will shed light on some of these questions and how we can make this epidemic of foreclosures a thing of the past. Thank you.
Great. Now for our first panel of the morning, we are happy to have three distinguished gentlemen who share responsibility for running the Making Home Affordable program of this administration. I'm pleased to welcome Seth Wheeler, Senior Advisor in the U.S. Treasury Department, Eric Schupenhauer, Senior Vice President and Program Executive for the Homeowners Affordability and Stability Plan at Fannie Mae, and Edward Golding, Senior Vice President, Economics and Policy at Freddie Mac. Mr. Wheeler, would you like to start with your opening statements?
I would, thank you. Members Neiman, Silvers, and Atkins, thank you for the opportunity to testify today about the Treasury Department's Making Home Affordable program and our efforts to stabilize the U.S. housing market and support homeowners. I'd also like to thank Chair Warren and Representative Henserling for this invitation, though they're not able to be here today. I'd also like to recognize some of the housing counselors and advocates that will be on the next panel who have been important partners in helping us understand how we can improve our efforts, as well as the servicers who are so key in implementing it. We announced Making Home Affordable, or MHA, in February, a plan to stabilize the U.S. housing market, support low mortgage rates, and offer assistance to millions of homeowners by reducing mortgage payments and preventing avoidable foreclosures. There are clear signs that MHA is already having a meaningful impact. However, as with any new program of this size and complexity, MHA faces a number of challenges. The administration is working to address these challenges and to expand and improve the program going forward. The Making Home Affordable program includes three key elements. First, broad support for the GSEs, Fannie and Freddie, to support mortgage refinancing and affordability across the market. We have supported low mortgage rates by strengthening confidence in Fannie Mae and Freddie Mac, including through a $200 billion increase in the stock purchase agreements and continued support for market liquidity. Second, we increased refinancing flexibilities for the GSEs, providing more homeowners with an opportunity to refinance to lower monthly payments. Lower rates have enabled nearly 3 million borrowers with GSE loans to refinance since the announcement of the administration's comprehensive housing plan. Third, a key part of the administration's broad housing plan is a comprehensive $75 billion program to lower monthly mortgage payments for borrowers, providing modifications on a scale never before previously attempted. On launching the modification program, we estimated the program could help as many as 3 to 4 million borrowers through 2012, targeting a run rate of 20 to 25,000 trial modification starts per week. 6 months into the program, there are clear signs that the program is working. Over 57 servicers have signed up for the program. More than 85% of loans in the country are now covered by the program. As of the end of August, servicers had approved and extended over 570,000 trial modifications offers. Also, as of the end of August, over 360,000 trial modifications were already underway. At the beginning of October, we will report on the substantial progress that has been made in September. We are above our target pace of 20 to 25,000 trial modifications started per week and are on track to reach our goal of 500,000 trial modifications starts by November 1st. But we can do better. On July 28th, we held a meeting with servicers at Treasury where we told servicers that they need to ramp up faster and treat borrowers better. We asked servicers to commit to doing better. Servicers must add more staff than previously planned, expand call center capabilities, provide a process for borrowers to escalate servicer performance and decisions, bolster training, enhance online offerings, and send additional mailings to potentially eligible borrowers. I'd like to note, I think we are making key progress here. The run rate of 20, we were hitting 20,000 modification starts prior to that meeting, and we've bumped up by 50% to over 30,000 since that meeting. But there is more to do. We are working with servicers and Fannie Mae to streamline application documents and develop web tools for borrowers. We are committed to transparency and accountability. First, on August 4th, we began publicly reporting servicer-specific results on a monthly basis. The second public report was published earlier this month. These reports provide a transparent and public accounting of individual servicer performance. In the future, we will expand the content of these reports to cover additional areas. Second, we are working to establish specific operational metrics to measure the performance of each servicer, and will include these metrics in our public reports. Third, servicers must report the reason for modification denials, both to Treasury and to borrowers. Fourth, we asked Freddie Mac as compliance agent to develop a second look process pursuant to which Freddie Mac will audit a sample of MHA modification applications that have been denied. The second look process began on August 3rd and is designed to minimize the likelihood that borrower applications are overlooked or inadvertently denied. In addition, we are improving borrower outreach, which is essential to the success of the program. We have launched a consumer-focused website, established a call center for borrowers, and launched a series of borrower outreach events in cities facing high foreclosure rates across the country. President Obama's housing stabilization plan has made significant progress in ensuring the flow of mortgage credit, bringing down mortgage rates, and providing many families with the second chance to stay in their home. We are on track to meet the goals we set for the program to reach 500,000 trial starts by November 1st and offer help to 3 to 4 million borrowers by the end of 2010. But we can and we must redouble our efforts to broaden the reach of these programs. We look forward to working with you and your staff to achieve these goals. Thank you.
Great. Thank you very much for keeping right on time. Mr. Schopenhauer.
See if I can continue. I appreciate the opportunity to participate in today's hearing on behalf of Fannie Mae. In my opening statement, I'll briefly touch on the main points of the testimony we've submitted today. First, as the Department of Treasury's administrator for the Home Affordable Modification Program, our principal activities include implementing the program guidelines and policies, preparing the requisite forms, tools, and training to instruct mortgage servicers on how to modify mortgages under the program, serving as paying agent to calculate subsidies and compensation under the program, serving as record keeper for executed loan modifications and program administration, coordinating with Treasury and other parties to achieve the program's goals. As Mr. Wheeler has testified, the program is making progress, and several extensions of the program are in the works or underway. To make further progress, we are focused on two main challenges. First, we're helping servicers to ramp up their operations to modify loans under the program. We are providing information and resources servicers need to implement the program through a special website for servicers and our own business-to-business website. We are also communicating all aspects of the program to servicers during the initial rollout and as program parameters evolve. And we are helping servicers implement the program and integrate with new systems and processes deployed for it. We work closely with the servicers every single day. We set up a servicer support call center. We have conference calls every week with the leadership of the servicers, and we provide ongoing training, both web-based and ongoing in-person for servicers. Our second main focus is on expanding borrower awareness of the program. For example, we help Treasury develop a website and a call center where borrowers can find out whether they're eligible for the program and find out more details. This website has received more than 36 million page views since it's launched in March. The call center offers free HUD-certified counseling if borrowers need in-depth help with their case, and it has received hundreds of thousands of calls since it launched on June 2nd. We've also produced consumer-oriented direct mail, flyers, and brochures describing the program, and we're expanding our program tracking system to collect data on borrowers who did not obtain a modification to find out how to further assist them. And we're supporting Treasury's efforts to train counselors so they can work more effectively with borrowers about the program. In addition, we're continuing to work with Treasury on the multi-city borrower outreach campaign that Mr. Wheeler mentioned. The goal is to draw struggling homeowners to events where they can meet with counselors and servicers and get the help they need. The events we've held so far drew nearly 10,000 borrowers that were in need of help. In 2 weeks, we'll be right here in Philadelphia as we continue to hit the hard-hit markets, the hardest-hit markets from a foreclosure standpoint. On top of our support of Treasury's efforts, Fannie Mae has also participated in over 140 foreclosure prevention events in roughly 70 markets in the United States, with a range of public, private, nonprofit, and industry partners. As we carry out the loan modification program, I also wish to note that through August, we've entered into 133,000 home affordable modification trial modifications just on Fannie Mae loans. We've also completed nearly 88,000 loan workouts outside of HAMP to help our borrowers. Finally, I'd like to touch on helping borrowers to refinance their homes. Last month, FHFA, our regulator, reported that Fannie Mae and Freddie Mac have refinanced more than 2.9 million loans this year through July. Of those, Fannie Mae has refinanced about 1.7 million loans. We've also made progress carrying out the Home Affordable Refinance Program to help our borrowers who saw their equity disappear as home prices fell. Previously, many of these homeowners were shut out of refinancing. Thanks to this program, borrowers with loan-to-value ratios above 80% and up to 125% can refinance for a better loan and a better chance to keep their homes. To support this program, we built out a loan lookup tool that's on our website where borrowers could determine whether we own their loan and whether they can get refinancing assistance. We also streamlined the loan process, and we offer new flexibilities on credit scores, mortgage insurance, and appraisals to support the program. In closing, the Making Home Affordable program has provided us with powerful tools to help borrowers modify or refinance their mortgages. The main program elements are now in place, and we are steadily helping more borrowers. Clearly, however, we have much more work to do and progress to make. Fannie Mae has been sees this as a critical responsibility, and will get the job done.
Thank you very much. Mr. Golding.
Members of the Congressional Oversight Panel, thank you for inviting me to speak today. I'm Ed Golding, Senior Vice President of Economics and Policy at Freddie Mac, and I head Freddie Mac's team that supports the President's Making Home Affordable program. Freddie Mac is proud to play a vital role in making home affordable, and in fact, MHA is our #1 priority. To help meet the President's goal of helping millions of families lower mortgage costs and avoid foreclosure, Freddie Mac has introduced 2 new initiatives. The first is our Relief Refinance Mortgage Program. It assists families who are current on their mortgages but cannot refinance because of declining home values. The program enables borrowers to lock in today's low rates and refinance loans up to 125% of the value of their homes. We also continue to support the broader mortgage market's refinancing needs. Freddie Mac so far this year has refinanced more than 1.3 million mortgages, and on average, these refinances reduce the mortgage rates by approximately 1.25%, 1.25 points. This saves families $4 billion per year. The second initiative is our implementation of Home Affordable Modification Program, or HAMP. HAMP helps at-risk borrowers keep their homes by lowering monthly payments to affordable levels. HAMP requires borrowers to go through a trial period after which the loan will be permanently modified. And through mid-September, we have approximately 80,000 of our borrowers have entered trial periods. We are working diligently to turn these trials into final modifications through direct outreach to borrowers. We are also pushing hard to get financially stressed families into the trial plans even before they become delinquent. Freddie Mac also plays a major role in MHA as the compliance agent for Treasury. In this role, we conduct examinations and review servicer compliance with program rules and guidelines and report these findings to Treasury. Because of confidentiality issues, Freddie Mac has created a separate business unit within the company known as MHAC to carry out these duties. MHAC has over 100 employees and is continuing to staff up. MHAC has developed an extensive and robust internal control and compliance system, and it has the authority to conduct both announced and unannounced audits of the servicers. Based on these reviews, we are identifying corrective actions and follow-ups with the servicers. We will be using a number of fraud detection and compliance techniques to identify borrower service and systematic fraud and to improve the quality controls in the servicers. Additionally, we are reviewing servicers' implementation of the NPV model, which is a key component for determining borrower eligibility. We are testing whether they are using the model appropriately as the program requires. Treasury has also asked MHAC to develop what is termed a second look process to minimize the likelihood that borrowers are incorrectly deemed ineligible. We are ramping up second look efforts significantly to increase the number of files reviewed and to help increase the number of HAMP modifications. In our reviews, we have found variations in how servicers communicate with borrowers who are deemed ineligible. As a result, Treasury has issued guidelines earlier this month to standardize and improve the process by which communication between the servicer and the borrower. And as more borrowers transition to permanent modifications and incentive payments are dispersed, we will be conducting audits to help ensure that the correct payments are made. As we move forward with MHA, we will continue to improve features of the compliance program to assist the greatest number of borrowers in need at the least cost to taxpayers. In conclusion, the employees of Freddie Mac come to work every day highly motivated to make a positive difference for millions of families by lowering mortgage costs and helping more families keep their homes. We are focused on meeting the challenges involved in fulfilling our duties under the Making Home Affordable program and helping to ensure its success. Thank you for this opportunity to testify, and I'm happy to answer questions.
Thank you very much for all keeping it within those timeframes, and we'll try to keep that as a habit. My first round of questions, I'd like to start with the metrics of success. Because that is what is published every month, and I think by which the program will be judged. And as Mr. Wheeler indicated, there, as of through August, there was reported 360,000 trial modifications started. But I think we would all agree, that the success of the program really will be the degree of permanent, sustainable modifications that are eventually implemented. Though the data may not all be in yet, particularly with regard to borrowers who have 3 months of payments, are there any estimates or targets, projections that the Treasury is using to assess what percentage of those trial mods can we expect or to convert to permanence?
Thank you for that question, because I think that highlights one of the biggest challenges and most important priorities for Treasury. As you've noted, as of the end of August, and as we discussed, 360,000 trial mods underway. When we update again with this month's report, certainly a good number more. It's absolutely critical for borrowers to remain in their home that they complete these trial mods and then ultimately are successful on their full modification. In terms of reporting, as you've noted, right now we don't have any robust reports that we've put out to date on full-time modifications. The number of full-time modifications is still very low. As you know, as you probably know, we put out a grace period of 60 days in ramping up the program. We laid out the program, laid out all the documentation standards that borrowers are required to complete. And to ensure that we have as high a conversion rate to full-time mods as possible, we instituted a 60-day grace period while we review all those documentation standards to ensure that as many of those as possible are able to convert.
Any best guesses? Are you operating under any operating assumptions as a particular percentage of those trial mods?
At this point, most of the information is anecdotal as we talk to services, which I'm sure you have. Right now, there's certainly a risk that a material portion of the borrowers, if servicers and collectively our efforts, if we're not able to close out those mods, there's certainly a risk that a high portion are not able to complete their trial modifications. There will be some who don't make payments, and I don't know exactly what that number is, but certainly not a trivial number. And another segment that don't complete even if they're making payments, they don't complete their trial, their documentation for completing the mods.
And we will hear information and issues around those documentation and outreach necessary to complete a permanent mod. The monthly reports also show great disparities between servicers in trial mod starts. Partly that could be the result of the fact that some trial mods may start with verbal information as opposed to those that utilize full documentation. Those requiring full documentation will of course have a higher conversion to permanent as opposed to possibly to those with verbal. Is this a concern, and is that an issue that you are rethinking to address that issue, or taking any actions to address that concern?
On that topic, I think you've correctly laid out the range of possibilities, and certainly that may not explain all of the disparity, but a good portion may be explained on how far along they're able to document before borrowers start the trial mod. I think we're again certainly concerned about this being I think our #1 priority now, as we've ramped up with capacity, that it's essential that we have a program with both documentation standards, as well as if we learn that documenting up front is much more successful than allowing flexibility to start a trial mod on the basis of stated, then I think we will rethink our standards and what we encourage servicers to do. At this point, we have given them that flexibility. And just to be responsive to this question and the last one, we will, as soon as we have more robust data, we absolutely plan on reporting as soon as we're confident in the data. And so we understand the critical importance of both being flexible on policy as we learn, as well as being accountable in reporting.
We're going to hear from servicers and borrowers later this morning, and we expect to hear that modifications are being hampered by responsiveness concerns, eligibility issues, servicer capacity. What is the one area that you would say that borrowers should stop doing, or that servicers should stop doing, or should be doing better to address those issues?
I certainly have thoughts. I don't want to usurp up all the opportunity to share perspective. So, Eric, do you want to?
Yeah, thanks, Seth. So I think from a servicer perspective, it's recognized that more needs to be done. We're in the ramp-up phase. Servicers have been adding staff, have been adding personnel, have been adding capabilities to handle the sheer level of documentation required under this program. I think that's taken time. That's part of the reason why we put the 60-day grace period in, is to allow that further ramp up without dropping people out of trial periods to get them into a sustainable mod. We'll continue to evaluate, and that's why spending every single moment we can to understand the issues and continue to iterate the program to better is
well, I'm over my time, unless there's a quick
let me just add
response
on,
to what a servicer should stop doing.
Standardizing the documents and reviewing which documents are necessary. Sometimes there's variation in how much documentation is taking place from servicer to servicer.
I think that's good. Atkins.
Sorry. Thank you. Well, thank you very much again. I wanted to move from maybe the macro level down to the micro level a bit. And when we talk about successful modifications, you've talked a little bit about that as you're looking at the programmatically overall. What about on the micro level? What makes a successful modification of an individual loan?
I'll take a first crack. I think successful modification, I think the only metric can be that the borrower is able to complete the trial mod and is able to remain in their home. We've designed the program that the incentives to servicers and borrowers will continue. The borrower incentives reach out for 5 years. The servicer incentives reach out for 3 years. We think that clearly tying those incentives out to that long a period, we think it's critical that in these challenging times that borrowers whose loans are modified don't just make it 6 months or a year, but they're able to stay in those homes and help in stabilizing those communities. So I think that that's ultimately the measure of success. Clearly, an early measure is how quickly we've ramped up. A next view will be how successful we are at completing trial mods into full-time mods, but ultimately the measure of success at the end of the day, when we look back 5 years from now, is how successful are we at helping these borrowers stay in home, helping economic stability and stabilizing neighborhoods.
So staying in their home and meeting their obligations.
And meeting their obligations,
okay.
Correct.
And then, is there any, do you have any tracking? I know it's still here at the early stages, but there have been some studies, and I guess we'll hear more about it a little bit later, but tracking of the ongoing nature of these modifications, whether, you know, we fall into a redefault situation and what sort of percentage that looks like.
Perhaps briefly, Eric could comment, as Fannie is running the data reporting efforts, and then Ed could comment, Mr. Golding could comment on the compliance efforts to ensure that we have accurate tracking.
Yeah, Mr. Atkins, we are tracking a number of data elements as we go through the program, and I think it's too early to tell at this point in the program. Your first modifications were done, the trial modifications in the May is kind of the most substantial April-May timeframe. You've had some period, but you haven't had enough period in order to assess. However, we do plan to provide a tremendous amount of transparency about the types of mods that have been done. Once they become permanent, I think that's the appropriate time to show how deep the mods are, the payment reduction, as well as their sustainability. And we are committed to providing that as we go forward.
Yeah, and we, of course, will be reviewing loan files, and it's, I think, important to point out we're reviewing both loan files that have been completed along with those that were not completed, that the person was determined ineligible. So we'll have data sort of in the jargon of sort of type 1 and type 2, both the ones that were given the mods, but we'll also be able to look at those that were not given modifications.
As far as geographic distribution of this effort, is it more concentrated on the coasts versus the interior of the country, or how does that pan out?
I think at this point, we don't have, we're starting to get the data and trying to verify the data. Certainly expectations is that, that the hardest hit neighborhoods, hardest hit areas will see the most number of modifications. Certainly California, Florida, Nevada, Arizona, and Ohio, Michigan are especially hard hit areas, along with a number of others. Pennsylvania certainly. And so I think we expect that we'll see modifications and should see modifications where the most need is felt. But we are collecting that data. We're starting to verify that data, and we will report in the coming months on a detailed basis around where modifications are happening and how successful we are in each area.
Okay, well, my time's up, so I'll yield the floor.
Well, let me pick up on some of this a little bit in the same vein. Mr. Wheeler, what is Treasury's estimate of the current rate in which foreclosures are being initiated, like on a monthly basis?
On a monthly basis, Treasury doesn't. We read analyst reports. Right, we don't have an independent estimate.
But what's your collective sense of the data you see?
I think several hundred thousand, certainly several hundred thousand modifications are being started each month.
No, I don't mean modifications. I mean, how many?
I'm sorry, foreclosures.
Foreclosures. Okay. And you said that the Treasury's target is 20,000 a week.
20 to 25,000 trial mods.
So 100,000 a month, roughly.
Roughly 100,000.
In light of that, don't you think you ought to be adjusting the goal? I mean, is the goal adequate? Is the goal of roughly roughly a million intake a year against a run rate of 3 to 4 million? Is that an adequate goal?
So I think, again, an excellent question. I think a response I'd make is in several parts. First of all, in defining where we're successful and what we've, in terms of who we're targeting to help, so the design and who our target population is in terms of borrowers, and then second, how well we're doing against helping those borrowers. And so each of those can be evaluated. I think on the first point on, are we trying to help all borrowers? And there are, we will still see millions, as you've noted, millions of foreclosure starts over the next several years. We are targeting a subset of those foreclosure starts, or those borrowers that are facing the risk of foreclosure. We've targeted borrowers who occupy their own home, right, or residence, borrowers whose loan balance is below 729, and then which we've deemed largely that we deem that the eligible population.
Mr. Wheeler, can I stop you there? What I'm really interested in is not the question, and I think my opening remarks indicated that. I'm not really interested in the question of, you know, who's been a good boy or girl and who's not. I'm interested in whether or not we're going to be able, with the targets you've got, and I understand that they seem appropriate at the time they were set, will that be sufficient to counteract the downward pressure of the foreclosure epidemic on our housing markets and our economy?
So I think not only are we trying to help individual families, but we are trying to stabilize neighborhoods. So the question certainly is our target population and who we're able to help in that target population enough to help stabilize neighborhoods. I think a second distinction I'd make is between foreclosure starts, which can certainly be traumatic for families and borrowers, and foreclosure sales, where borrowers actually lose their homes. The foreclosure sales rate is much lower, but still very, very high. I think we are right now focused on, as quickly as possible, getting the program up and running, implemented. As you know, for our entire target population, we have a rule that servicers are not allowed to to go through foreclosure sale until a borrower has been fully evaluated, and we strongly encourage them not to even initiate foreclosure proceedings until a borrower has fully been evaluated. I think we are trying to move as quickly as possible to help as many borrowers as possible. But I think in terms of neighborhood stabilization and as we watch foreclosure sales rates and borrowers losing their homes, I think we will, as with all of these things, need to continue to evaluate whether we're in the right place. And with any of our rules, whether it's who we're targeting or how well we're reaching that, we'll need to continue to evaluate.
Right. Mr. Wheeler and other members of the panel, I think we had hoped that you might be the last panel rather than the first. We understand, so that you could benefit from the other witnesses, we understand that was not possible for scheduling reasons. I think that's regrettable. However, I'm going to do my best to make up for it by giving you a glimpse of the testimony that's going to be heard later in the day. This is from Erwin Traus, who's the supervising attorney for Philadelphia Legal Assistance, and I'd like you to react to these statements. He says, "The non-compliance with the HAMP guidelines is pervasive, and the absence of a meaningful and he's talking about servicers, and the absence of a meaningful method to challenge this non-compliance is frustrating to advocates, particularly to housing counselors who were led to believe that HAMP would be streamlined and self-effectuating without the need for an attorney or for litigation." It's an odd thing for an attorney to say in a way. To address this situation, and I'm cutting and pasting here, to address this situation, we need a multi-pronged approach that is not dependent on the willingness of the mortgage servicers to agree to the solution and is not dependent on the lenders themselves determining for themselves whether they have complied with the requirements of the program. Can you comment on that assessment?
I'll take just 20 seconds and then let Mr. Schopenhauer and Mr. Golding cover the balance. We've certainly heard those concerns. Much of that is real in terms of concerns, and so has been a primary part of our focus in recent months. The comment I'd like to make is just briefly in terms of empowering borrowers and in terms of providing transparency around the process has been one of the key areas of feedback we've heard from housing counselors and advocates. So we are undertaking a number of initiatives, many of which I outlined in my opening comments. I'll let Mr. Schopenhauer comment in more detail on that effort, but on the back end, equally important is the compliance role that Freddie Mac is playing in ensuring that where there are servicers who mean well but not getting the job done, that recommendations can be made by Freddie Mac to close that gap, or penalties assessed as appropriate if compliance remains a problem. So, Mr. Schopenhauer.
Thank you, Mr. Wheeler. So I think two important points here. First, there's an escalation process that we've put in place that I think can serve the borrowers very, very well. First, they can contact the HOPE hotline that's been established, 888-995-HOPE, which is a trusted source for information. The other is counselors can also contact our HMP admin center if there are pervasive issues. Finding out about those and dealing with those is of paramount importance from our standpoint, so we can get the right training and right tools out there in the servicer's hands. And I'll turn it over to Mr. Golding to talk more about the compliance.
Yeah, as I mentioned, we launched Second Look this month. We soon think we'll be able to have a large enough sample so that we would be able to detect whether any servicer was systematically denying modifications that should have been approved.
So I'm going to use my time to follow up on those compliance issues, because that really is the bulk of what we will be hearing from housing counselors at the next panel. Evidence that servicers may not understand the various terms, specific noncompliance or violations of the HAMP guidelines. I'd like to understand a little further about what are the compliance process schedules that Freddie Mac really intends to employ, and also what kind of reporting will there be? How transparent will it be, both in terms of overall compliance, but also servicer by servicer reporting? And also, to the extent that you can address, what's the response, are there any remedies built in as a result of that noncompliance for borrowers or sanctions against those servicers? I threw a lot at you, but
yeah,
please do your best.
Well, please come back to me if I missed any of them. Basically, in terms of the review of servicers, I sort of do divide it into two. One is sort of the on-site visits, looking to see what their procedures are, lining them up with HAMP. Are they basically implementing HAMP as directed by the guidelines?
What kind of staff do you, what's the staffing for this? This is a...
We currently have 100 employees. We're ramping up. Our expectation is to be around 200, and we will use contractors as necessary to make sure that we're adequately staffed to reach the servicers that we need to reach. But it's basically first lining up, I think of this as two steps. First lining up their procedures with the HAMP requirements, and then the second test is going back and seeing whether or not they properly implemented the procedures. So testing against their stated procedures, including looking at individual loan files. I should also point out, Eric talked about the escalation process. We are also in constant contact with Fannie Mae as the program administrator, listening to what complaints they're getting, following their data also.
And those violations, then, once those violations are identified, they will be reported to?
Well, the first, this goes a little bit into the remedies. Clearly, if there's a violation where there should have been a modification, our first thing is to stop the foreclosure and make sure that the homeowner gets the modification. You then, well, there's two areas you want. Let me go to the reports, and then I'll get to the remedies, and I think I will have covered the three prongs. We will, the reports, we are an agent of Treasury. The reports will be written up servicer by servicer and given to Treasury. We're in discussions with Treasury as to how much of that information, what the content will be made public, and that's still to be determined. As for the remedies, clearly there's a range of remedies that we've talked about. One of them would be to withhold the servicer incentive payments that were discussed. Clearly, remedies could go as far as terminating someone from the program. That's not a remedy you would want to use readily because all you're doing is hurting the homeowner on that. So what we really are focused on are correcting and making sure the homeowner gets that modification. I think correcting the procedures are the most important. If they are not implementing properly, getting to the servicer, having them correct, and making sure that they try to maximize the number of eligible borrowers that are offered.
So if I heard you then correctly, decisions with respect to making these reports public and in which format, as well as sanctions, are still open issues that have not yet been decided?
They have not been decided. Certainly we have a strong commitment to ensuring, supporting Freddie Mac in their role as compliance agent and ensuring, first of all, that these problems are identified, ramping that up to reports, and we will make public the frame. Exactly what the content will be has not been determined, but then also to levying appropriate remedial measures.
In my last 30 seconds, I'm going to ask for a one-letter response. What I'm going to like to do is, I think we should all be evaluating each other's performance. So what I'd like you to do is give a grade to the servicers in assessing their performance, recognizing this may be the first semester in terms of A to F. Collectively, as a group of servicers.
If I'll be careful in my definition.
Okay.
If C means average, then I think then I give them a C. In the sense, I think on the plus side, they're doing very well, again, against program goals, but we have a lot more work to do on helping borrowers and implementation.
Any other differences in grading?
I think it's a fair assessment. It's the first semester.
Okay.
Obviously, I've had college-age kids. So Seth, there's been great inflation since you've been in college. I gave one of my students a B+, and he complained it was the lowest grade he'd ever gotten. I had ruined his life. So under the old scale, I think C is appropriate. Maybe under the new scale, they don't give C's anymore.
Okay, thank you.
Sorry.
Well, I wanted to turn to costs then, the flip side of all of this, because, when you were talking about $4 billion of savings on the Freddie Mac side for borrowers, obviously the money's coming from somewhere. So I was wondering if you all could address what the estimated cost of all of this activity is so far to the taxpayers in general. Obviously, we're talking to both of Fannie Mae and Freddie Mac now are explicitly government entities, but.
So there are at least three different types of costs. There's the cost that TARP direct outlays in terms of the financial instruments, the SPAs that enable the non-agency programs to operate. There's the costs associated with, and it's a little bit more nuanced in terms of the modifications occurring for Fannie and Freddie, because obviously with loss mitigation, it avoids future losses on Fannie and Freddie. So there's a lot more nuance. And then the program administration costs on what we pay Fannie and Freddie. And right now, as you can see, on the third one, we don't have a detailed cost estimate. We are trying aggressively to manage costs, and Fannie and Freddie are certainly they're doing their best to keep costs down. But we also want to do the program right, so certainly we're trying to balance those two things. On the first two, we've estimated, we've allocated up to $50 billion in costs for the program, and the process by which that's allocated, or I should say obligated, we go through each time a servicer signs up and establishes a servicer cap for the instrument that the agreement that we purchase via Fannie Mae on Treasury's behalf. And so right now we have a certain amount that's been obligated. That doesn't mean all of that will go out the door. And then ultimately we have more flexibility to increase those obligations as need be through the end of the year. I think it's important to note that right now very few dollars have gone out the door, and the program is structured so that we only pay for success. No trial modifications unless they're successful cost the taxpayer a dime. And when they are successful, even then the incentives are backloaded, so the servicer can earn much more through a complete successful modification than they are just through even completing a trial mod. So we've tried to be very thoughtful of shepherding and stewarding taxpayer resources. But again, this is a strong priority of the administration to achieve economic stability and stability in the housing market. So it's certainly we are thoughtful on both sides. Any further?
On your individual side.
I might just add that part of what we're doing in general is just lowering the frictions in the mortgage market and trying to get it easier to get the modifications, easier to get the refinancing. And I think to the extent that you lower the frictions, the transaction costs, that benefits the system.
And as we stated in our testimony and in earlier questioning, I think that the transparency around this is something we hold very dear. It is in early innings or early semester, however you want to phrase it. Very few dollars have gone out the door, but we will be giving a full accounting as we go through time, a very full public accounting in terms of the cost of running the program as well as the cost involved in the incentives to make these modifications happen and be sustainable. So.
Well, I have a little bit of time here remaining. I wanted to focus on quality control a little bit, and just how you all are focusing on that internally, as far as whether internal audit or you have a special program that is supervising these internally.
Sorry, are we talking compliance?
Yeah.
So,
yeah,
Mr.
sorry,
Goulding,
yes.
do you want to take a first answer there?
Yeah, I mean, I guess the simple answer is yes. We have internal audit. They obviously report independently to the chair of the audit committee. They have, reviewed our processes both. Don't forget, we have two functions. One is we're implementing the president's program on our own book, and then we have the separate unit, MHA compliance, and audit has been involved in both of those.
And Mr. Atkins, I'd also point out OFS, the Office of Financial Stability within Treasury, obviously has its own compliance function and dedicated teams that work with the Freddie Mac in designing compliance protocols and ensuring that these programs hew as closely as possible to all and are fully compliant with all the directives we've been given.
And I'd be remiss not to mention we also have a federal regulator who has also reviewed our implementation.
Right. And the and the Special Inspector General for the TARP program, has he been involved yet with this with you all?
Certainly, at various points, SIGTARP, both Mr. Barshovsky as well as his team have been consulted. They've been very constructive and thoughtful. They've challenged us to think more deeply about how we can do a better job and given us very good feedback, as well as I should point out the GAO has also given us constructive feedback, and we have tried to be very open. Much of that is very, very good many of those are very, very good recommendations, and we've tried to act on nearly all of those to improve the program.
Okay.
I want to continue on the vein of testimony you haven't heard yet. First, I read you a quote before from Mr. Traus that would appear to allege a fair amount of improper conduct by servicers trying to avoid restructuring people's loans. You testify, one of your testimonies, I believe Mr. Wheeler's testimony, you talked about you have an interagency group that's met to discuss fraud and other misconduct involving law enforcement and so forth. I would like Mr. Traus's testimony reviewed as to whether or not it constitutes a legal problem in any respect for any servicer. In particular, whether or not any servicers are accessing TARP money upon assurances that they are doing things which they are not doing, which strikes me as raises a whole series of rather serious legal issues, if that's the case. Now I'd like to come to some other testimony. Briefly, two issues, two important financial issues are kind of in play in later testimony. One is what the likely redefault rate is going to be on mortgage restructurings, and secondly, the issue of self-cure. How many people, having been served a foreclosure notice or getting 60 days behind, how many people are actually able to get out? There's some historical data I gathered that suggests that self-cure rates of 30% have been common in the past. On the other hand, we're not really in the past, and there's data from Fitch that says that self-cure rates now are 6%. Do any of you have an opinion as to which number is the right number to be thinking about here as we look at the economics of restructurings?
Go right ahead.
Sorry. So first of all, it's been a while since I've looked at the Fitch study, and we'll be glad to get you, a further answer later. But as I read the study, the Fitch study is sort of a little bit of an apples and orange versus the long-term rate, because the 30% cure rate, and sometimes you'll hear as high as 50, depending on how serious the delinquency is, tends to be the long term. As I read the Fitch study, they were looking at a shorter time period. So I will have to go back and make sure that to see whether they've lined up the time periods. But as I read that, there was a difference. But I think your basic point is absolutely right. We have to wait and see. This is a very different environment than historical studies. where you saw just a few local regions with down
But you don't
house prices.
Mr. Golding, you don't
coming back.
disagree that the 6% number is the data we have on the current environment, although it's short-term.
I agree that it is likely to be that the cure rate is likely to be low.
Lower than historical
Lower
numbers.
than historical.
That's-
I'm not sure.
that-
Yes, I
right.
agree. Yes.
Mr. Wheeler?
I'll wade in with a few thoughts here. You started with redefault
Yeah.
and how
Right.
clearly redefault is essential for how we establish metrics for success and how
Right.
we measure how well we're doing, as well as in the MPV model.
Right.
We started out, we've had a number of teams, interagency across both federal regulators as well as the enterprises, and in developing an MPV model, they looked at the experience of OCC OTS.
Right.
They looked at the FDIC experience. They looked at other reports on redefaults to try to start a benchmark of what a set of redefault assumptions might look like given certain borrower characteristics. I think importantly, though, we certainly hope some of those reports have indicated a very high redefault rate, and we do expect redefaults. But I would highlight we, in program design, many of our efforts to try to minimize those.
Mr. Wheeler, is it not the case that if you design a poor mortgage relief program, one that doesn't grant real relief, that redefault rates will be very high? And if you design one that actually is sustainable, redefault rates will be lower. Is that?
Clearly, the better job we do, the lower the redefault rates will be.
And your program is, I believe, I would hope you would agree, your program is significantly more helpful to borrowers than the voluntary mods that were going on prior to the adoption of your program.
There are a number of safeguards that are intended to achieve that.
Right, but you've got a 31% income to payment number, right? That
Correct.
wasn't common
There
prior
are,
to your program, was it?
Several of what we believe to be improvements, and it's required that every mod, HAMP mod, target a 31% debt-to-income ratio, the payment relative to their income, but also fairly robust documentation to ensure that we get that mod at the right level. Again, aligning success payments so that servicers and borrowers are both incentivized to keep borrowers current.
Okay.
So we certainly expect that our performance will be much better than it would have otherwise been. It's still hard to say how much better.
My time has expired. I would like you all in writing to respond to the suggestions by a number of our witnesses that will succeed you, that as part of the federal program, we adopt a HEMAP-like program for unemployment, that we have compulsory mediation of the sort that goes on in Philadelphia as a result of the court system, and that you look at outreach canvassing of the kind that goes on here in Philadelphia to actually find people. I would appreciate it in writing. Thank you.
We will do.
I'd like to thank the panel, and before dismissing you, I do want to highlight, particularly for members of the public, that though this is our first public setting with the three of you, we have been in regular contact, certainly with the Treasury, both at the senior and staff levels. Both of you have also offered ongoing commitments to dialogue, both in informal and in informal sessions, and we certainly will take you up on that and look forward to that continuing dialogue. Again, I thank you for making the trip here, and we look forward to your continued involvement and response to the requests that we made during the panel. Thank you very much.
Thank you.
Thank you.
And now we'll do a transit to the next panel of counselors. Thank you very much.
Yeah, considering
Oh, you checked your water. Great. Good. Thanks.
guess this one is mine.
Good morning, and thank you for joining us. Our second panel is here to give us the homeowners, the borrowers' perspective on foreclosure mitigation, and we really are privileged for the panel that we have here this morning. From your left, we have Judge Annette Rizzo of the Philadelphia Court of Common Pleas and the Director of the Philadelphia Mortgage Foreclosure Diversion Program. Erwin Traus, Supervising Attorney for the Consumer Housing Unit, Philadelphia Legal Assistance. Eileen Fitzgerald, Chief Operating Officer for NeighborWorks. And Deborah Goldberg, Director of the Hurricane Relief Project for the National Fair Housing Alliance. And again, I'm going to ask each of you for your opening statements. Please do try to keep them to the 5 minutes, leaving time for questions and answers. Judge Rizzo?
All right, thank you. Of course, Mr. Newman, Mr. Silvers, and Superintendent Atkins, great to have you here. Build it, and they will come. Such were the words which started my testimony approximately 1 year ago when Senators Casey and Specter came to Philadelphia to have a Senate Judiciary hearing on our programming. In June, when we passed the 1-year mark on our program, our motto or slogan was, "We built it, and they came." We welcome you as the Oversight Panel to Philadelphia to focus on our efforts on a very homegrown local effort to stem the flood of foreclosures happening throughout this country, and in particular in our city. I want to just share with you some obviously overarching aspects of our program that we have in place, as well as some lessons learned in the year and a half we've been in progress, as well as maybe some of the challenges we face, which have been really introduced by the first panel in terms of us implementing the provisions that we now have out of Washington regarding HAMP. Since our inception, we've been the subject of a multitude of media events, locally, nationally, and even internationally. We've been the subject of conferences both in the legal and business communities, and a blueprint for the implementation of programs across this country, either locally or on a state level. We've gotten inquiries as far as Alaska to Maine and even to the Paradise Island of Hawaii. In a judicially driven foreclosure state such as Pennsylvania, we really view this program as one of effective case management, and this is, of course, from the judiciary's perspective, to stem the tide of really an increased caseload over the last years where equitable remedies are available. It is not perfect. It is ever evolving in circumstances which change as new relief plans avail themselves. However, programs such as ours, which are locally based, serve as the staging, really, and the theater in which direct and timely relief can be crafted for homeowners on a micro basis. We are in extraordinary times. I don't refer to it as the crisis, that's the C word, we don't use that here. But we see this really as an era of new financial challenges, the likes of which we've never faced in our lifetime. And it's in need of extraordinary response. And I really often talk about this in more lofty terms, but as problem solving, we often look to new ways to deal with existing problems. And I say, let's flip that. Let's really look at a new situation in an old way, what I kindly refer to as the George Bailey building and loan model. That was a system where local bankers really knew those customers who came into the bank, their highs and their lows of finances. And based on that strong financial relationship and personal relationship, banking was conducted. We are returned to that community banking. We are really infusing in this system to try to go through the myriad of all the complexities of these new programs to really be that human touch, that connection, as you'll see in our courtroom as you visit us hopefully this afternoon. Our program is really all about the face-to-face between the lender and the borrower. We have created a forum in which lenders and borrowers can dialogue in good faith to bring about sustainable and, more importantly, attainable and, more importantly, sustainable solutions to keep borrowers in their homes. The provisions under the HAMP program have provided a useful roadmap for participants in our program to achieve such results. This is not to say that we have not encountered some bumps in the road, bumps which I believe are not insurmountable. Now, just briefly, the program did begin in June of last year, and we have passed the 1.5-year marker. It was really based on a prototype I developed in 2004 when a moratorium was declared, or at least requested by our sheriff, local Sheriff John Green. The moratorium was not given. I really call that the M word. But instead, we did a prototype of actually stopping the sales, looking at these cases on a real micro basis to see if really we can do some workouts. And we did achieve a success for that. In addition, we also convened a group of stakeholders from all sides of the issue to come together and meet on a regular basis for 4 years to deal with some of the issues dealing with foreclosures in general and our procedures. And that really is the genesis of the program, because this steering committee, having lender bar, consumer bar, the city, the sheriff, also all nonprofit groups involved with the issue at the table to try to develop the program, and such is the beginning of it. So we've dealt with day backward cases where we literally did pull cases off of the sheriff's sale block to see if we can actually do workouts, and that was really the beginning of our program. But now our focus is more on the day forward program, whereas all cases filed in Philadelphia after September 8th of last year are subject to then a conference which we schedule 45 days out. Lenders are required, as they are in any civil action, to file the civil complaint of foreclosure, along with a notice to the homeowners that they must immediately call the Philly hotline, Save Your Home hotline, which Mr. Traus, of course, will talk to you in more detail about, and as well as to attend a conference which we schedule automatically at the filing of the complaint. In that window, it's very important that then we see truly a marriage between the courts and non-judicial entities, such as community outreach groups, which literally, with their staffs who are expert in this, go out to canvass neighborhoods and actually reach people at their doorstep, ring the bell, and go on, you're in foreclosure, did you call the hotline? Did you call the hotline? You didn't. Here's my cell phone. Call the hotline. And we affectionately have then these people in the chute.
Judge,
So
if you could start wrapping up. Thank you.
That said, we have had over success in terms of having a series of about 6,300 conferences through. We have about 1,500, which we say in terms of actually homes we've saved from foreclosure. Approximately 3,000, according to OHCD, are actually in queue to be resolved, postponement with purpose. And we only look forward to actually more iterations of this as we move forward out of the pilot phase into really an established program coming 2010. And I'm sure I have more to comment on in terms of reaction to some of your questions. Thank you for your time.
Thank you. Mr. Traus.
Thank you. Members of the panel, I'd like to thank you for your invitation to share my perspective on the MHA program and the HAMP program as they relate to the availability of mortgage modifications for folks facing foreclosures in Philadelphia. I want to start by saying how privileged I am to be on this panel with Judge Rizzo. Judge Rizzo really has been the driving force behind this diversion program, and it would not work to the extent that it does without her dedication to trying to save people's homes. And this is one of the reasons why I'm worried about the replicability of this program, because not every location is going to have a Judge Rizzo.
I'm a Gemini.
Oh, maybe there was another one in the country. I also want to applaud the efforts of the Treasury in creating the Making Homes Affordable program. I think the program, if mandatory, if implemented as designed, could help a broad spectrum of people facing foreclosures in a way that would have little impact on the Treasury and would have a tremendous impact on avoiding foreclosures. However, there are areas in which making homes affordable as designed could not help, even if it worked 100%, and one of those is addressing the needs of the unemployed, as Mr. Silvers has already indicated. And making homes affordable was not designed to and cannot address the needs of people who can't pay their mortgages, fair mortgages, decent mortgages, simply because of the onslaught of unemployment and the crisis, I'm sorry to use the word, but the unprecedented levels of unemployment that we're experiencing. And to address that, I think some of the TARP money, which has been recovered from the banks, should be repurposed for the purpose by this MHA program. I think an additional program could be created along the lines of the HEMAP program in Pennsylvania, which, by the way, over its life has recovered more money than it's paid out to homeowners for grants and loans which could be used to enable people to pay arrears and for continuing assistance to pay mortgage payments or part of mortgage payments while people are unemployed. I'd also like to comment on a couple things that were said by the previous witnesses. One about the Hope Now escalation team, which we just found out about 2 days ago, We called yesterday, and they don't know that, Hope Now does not know that there's a Hope Now escalation team as far as we can tell, at least the person we spoke to on the phone. We run a hotline. We need to know these things. We're always trying to find out where can you go. We called Hope Now. We said, we want to talk to somebody in your escalation team. They had no idea what we were talking about, and they said they do not do any sort of enforcement, that what they do is help consumers and make referrals. So I don't know if the Treasury people are still here or the Fannie Mae is still here or Freddie Mac, but they need to get the word out to Hope Now that there is an escalation team.
We will make sure that that is conveyed back to the Treasury.
Also, with respect to the remedies, from our experience, the servicers would like nothing better than to be kicked out of the program, at least some of them. I mean, many of the with respect to, you know, what can you do to a servicer who's not complying, many of these servicers seem to be very reluctantly involved in this program and really would love for business to go back to normal, where they hound homeowners and foreclose, take sales to sheriff's sale, because that's what they know how to do. They can do it quickly, they can do it efficiently, they can do it cheaply, they make lots of money doing it. So the threat of being bounced from the program, I don't think, is a significant threat for compliance. From my perspective, despite the promise of the program, HAMP and MHA have not been particularly helpful in the diversion program with respect to achieving permanent modifications, and I think that's reflected in the numbers. It has been helpful in the diversion program because it served to slow down the foreclosure process while lenders have been acting on HAMP applications. And it's provided some leverage to advocates to press for meaningful resolutions. But simply put, lenders are avoiding making permanent loan modifications, and as long as homeowners have no leverage to force such modifications, they will not happen in great numbers. Overwhelmingly, as has been pointed out in my written testimony, servicers are not complying with the guidelines. They're doing it with impunity. Services generally, in my limited experience, and I'll talk about the limits of that experience, servicers generally seek ways to find homeowners ineligible. Even when servicers provide trial agreements, they do not provide permanent HAMP modifications at the end of them. Instead, we have seen them offer arrangements that are less favorable than what HAMP requires. As I pointed out in my testimony, there's a slew of inadequacies with respect to enforceability of the program. But I'd like to make 2 points which are related to enforceability and taking the problems out from the discretion of the homeowner, of the servicers. One is that in the Housing and Economic Recovery Act of 2008, $30 million was provided for attorneys to help homeowners prevent foreclosure. Because of the way the Neighborhood Reinvestment Corporation is interpreting that statute, the regulations prevent that money from being used by lawyers representing people to defend foreclosures, including participating in the diversion program. That needs to be changed.
I'll give you an opportunity during the question and answer. That was my first question on change. So if you could just wrap up.
And well, to wrap up, if you want the MHA to work, if you want HAMP to work, I think the most important thing is to convince the Senate to pass the amendments to the Bankruptcy Code that will give the Bankruptcy Court the authority to modify mortgages and make them affordable without incentives to the homeowners. And if there is a threat, then you're going to get lenders doing what we need them to do. And thank you again for the invitation.
Thank you. Ms. Fitzgerald, thank you.
Thank you, Superintendent Neiman, Mr. Atkins, Mr. Silver. Thanks for the opportunity to talk with you today about NeighborWorks foreclosure mitigation work, excuse me, and the feedback we have received on negotiating modifications under the Making Home Affordable program. By way of background, NeighborWorks is a congressionally chartered nonprofit. We were established in 1978 with a statutory board which includes the directors of the federal financial regulatory agencies, Secretary of HUD, or their designees. Our mission is to expand affordable housing opportunities, working through a network of more than 235 community-based organizations. NeighborWorks was at the forefront of identifying the foreclosure crisis, creating the NeighborWorks Center for Foreclosure Solutions 5 years ago. In December of 2007, NeighborWorks was named the administrator of the $180 million National Foreclosure Mitigation Counseling Program, which was created under the 2008 Appropriations Act. 2 additional appropriations have been made since then, $180 million in July 2008 and an additional $50 million in 2009. To date, 674,000 homeowners have received counseling through NFMC's 1,700 grantees and subgrantees. During this foreclosure crisis, working with servicers has posed challenges for counselors across the nation. While many issues are being addressed, working with servicers has continued to be a challenge since the launch of MHA. Before I discuss the challenges, I do want to point out that MHA includes a number of really successful components. The trial modifications have been extended and initiated. The 31% front-end DTI requirement really improves borrowers' chance of success and was a critical element. The willingness of both servicers and Treasury to get input on the modification process and their commitment to addressing issues identified, and the addition of the MHA-FHA program. Back to challenges. NeighborWorks recently held a series of 7 feedback sessions with NFMC counselors on MHA implementation, uncovering 3 major themes: difficulty communicating with servicers, servicers not following MHA program guidelines, and frustrations with the system as a whole. Given the time constraints, I'll just address a few of these. So, difficulty trying to communicate with servicers. Counselors noted that many servicers will not work with them. Some servicers still ask for their Social Security numbers, even though servicers have directed staff not to continue this practice. Counselors also told us they spend as much as 2 hours on hold trying to reach a servicer, and then frequently are transferred to numerous phone lines before getting answers for their questions. Some servicers have contracted with third-party collection agencies who call borrowers demanding payments and do not address refinance or modification options. Challenge 2, servicers are not following MHA program guidelines. Counselors gave many examples of servicers not helping homeowners who were current on their payments, but who knew they would have trouble making payments in the near future. Instead, the servicers advised the borrowers to stop making payments and call back when they were 30, 60, or even 90 days delinquent. Counselors also reported that some servicers would not disclose terms of a modification or a payment breakdown or put their offers in writing. In one case, a servicer made 3 separate offers to a borrower on the telephone and then sent the borrower a letter stating she was ineligible for a modification. Servicers are giving out misinformation about the program, stating only that only Fannie and Freddie loans are eligible, or misstating the required front and back end ratios. Other servicers are offering other workouts before MHA workouts, which clearly is not supposed to happen. MHA modifications are supposed to be offered first. Counselors also gave examples of a number of servicers not halting foreclosures while reviewing files for MHA eligibility. In one case, the servicer moved forward with foreclosure sales when clients were being reviewed for MHA. In California, where there is a 90-day moratorium on foreclosure sales. When asked about this practice, that particular servicer said they were exempt from state and MHA requirements. Challenge number 3, frustrations with the system as a whole. Counselors gave many examples of servicers not giving explanation of a denial for HAMP. They also noted it takes too long to get a response to the modification request, 2 to 3 months for a trial modification. In some cases, counselors are required to resubmit the same packages when servicers lose documents or take so long to review them that the data in the document is outnumbered. Finally, a few thoughts on program improvements. NFMC counselors support the creation of a central portal for submitting modification requests, such as Hope Now and Treasury portals are currently under development, we hope. They also would like uniform procedures and forms. The efforts currently underway to establish uniform servicer guidelines would assist counselors immensely if that happens. And finally, counselors say they could be more effective if they had access to servicers and PV models to understand how servicers determine MHA eligibility. In sum, government entities, counselors, lenders, servicers, investors have to continue to work together to address this crisis and improve the effectiveness of the programs.
Thank you. Ms. Goldberg.
Thank you. I want to add my thanks to that of my co-panelists here for you all holding this hearing and for inviting me here to testify. I'm here on behalf of the National Fair Housing Alliance, which is the nation's only national organization that's exclusively devoted to eradicating discrimination in the housing market. As noted, I run the Hurricane Relief Project at NAFA, and so since 2005, our project has been working with homeowners in the Gulf to help them recover from the storms of that season. What we have found is that many of the homeowners that we have helped would be facing foreclosure even if hurricanes Katrina, Rita, et cetera, had not occurred. And the reason for that is that they have the same kinds of unaffordable and unsustainable mortgages that so many other homeowners around the country have, and whose failure has really launched this current crisis. We do view it as a crisis at the National Fair Housing Alliance, and we are very mindful of the fact that to a large extent, the costs of this crisis have been borne by people of color and the communities in which they live. We have decades worth of research that tells us that these borrowers and these communities have been targeted for the kinds of loans that are not sustainable, that are high cost, that are high risk. And they have been on the front lines of this crisis. It's been estimated that people of color over the last couple of years have lost hundreds of billions of dollars worth of equity as a result of foreclosures. That's going to have a profound effect on their family's financial security now and into the future, and it may take us generations to be able to recover from that. The foreclosure crisis is unraveling several decades worth of concerted efforts by a lot of people to promote community revitalization and wealth building in our nation's cities. And I want to say, I think it's been pointed out that the misery now is being shared by a lot of other people, that loans that might not be considered unsustainable and unaffordable are still going into foreclosure. That's not the kind of sharing that I think any of us want to see. With a crisis of this proportion, we think it's been imperative for the government to intervene, and we applaud the Obama administration for launching the Making Home Affordable program and HAMP. Several people have already talked about some of the key elements of that program that have had a really positive impact on the market within limits, and we want to support those things, such as the affordable payments and some other things that have been mentioned. And I want to say that we've been trying to work since the beginning with Treasury and other government officials to try and improve the program's operations. I think the early numbers indicate that HAMP is on target to meet its goals, but as has already been discussed extensively, and as we certainly believe, those goals are too modest. And the number of foreclosure starts that are projected far outweigh the number of people that we expect that the program will be helping, and our goal needs to be to stop foreclosures, not to meet the goals that have been established for HAMP. My written testimony describes a number of operational programs with HAMP and suggests a bunch of changes that we think would strengthen the program, would increase its transparency and accountability, and extend its reach, and makes a number of proposals for steps outside of the context of HAMP that we also believe would help us deal with this crisis more effectively. Clearly, I don't have time to go through those all, so I'm just going to focus on a few. I want to point out two that I think have particular fair housing implications. One is the data that are collected and made public about how servicers are performing under the program. We think it's very critical that loan-level data, including information on the race, gender, and national origin of the borrower who's applying for a HAMP modification, be made available to the public, and that be done at a geographic level that makes it possible for public officials, community organizations, individual borrowers, and the public at large to understand how the program is working in their communities, to be able to identify places where it may not be working equitably or effectively, and to intervene to change that. A second thing is that we think that there needs to be better support for borrowers, and particularly for outreach into communities where English is not the primary language. Third, we think that the NPV model must be made available to the public. Borrowers should know what information about them and their home, and a particular concern to us is how the value of that property is assessed, is put into the model, and what the model tells them, or what comes out of the model about whether they succeed or not and by how much they fail. And it's particularly important to catch folks who are, just barely fail the model's analysis. We also make some suggestions for ways to make the model more accurate. We believe that it's critical to establish a strong, effective, and neutral appeals process that is borrower-initiated, that where someone outside the system, not in the servicer's shop, can review an application to make sure that it was handled appropriately. And finally, I would say we think it's really important to stop all foreclosure actions, that we are hearing of far too many borrowers who are either having foreclosure initiated or moving along the path towards foreclosure, even though the final sale may not be may not take place. And that racks up a lot of costs that undermine the ability for a successful modification. And I will stop there and welcome your questions.
Thank you. Our intent for this panel was to get the borrower's perspective, through the views and the eyes of advocates and judges like yourselves. You have represented them well. The testimony that you all have provided us, in my opinion, is really the most comprehensive summary of the significant issues facing this program, and will really serve as a terrific basis for us in our work, as well as in our interaction and presentation, reports to the public, and interaction with Treasury. My first question is to really expand on your reports, not only as a follow-up to the issues that you've identified, and give you an opportunity to really address what is the most important change in either in the program design of the Making Affordable Home program or in its implementation. If we had to leave here with one critical, and I was going to start with three, but I know we're pressed for time, and since some of you may overlap, think of the one most important change that we really should be looking for, recommending with respect to the design of the program or the way it's being implemented. I'll start with anybody who's like
I'm going to start first, and again, I hope I can get your ear more when you come calling and visit with us, because we have more to talk about. But again, I have obviously the view from the judiciary, so I'm sort of level on all sides. Parties come to the court by due process equally. But I have to say, in terms of actually on the ground running, I go to my colleagues on this panel to discuss it. But bottom line is, I don't know about tweaking it anymore, other than just reducing it down to fine points and getting the word out where it's easy read language, and that we have direct, what I would call backphone hotlines to really get clarity on points. Through association I've had, being on panels in Washington, et cetera, I've had outreach to individuals who I personally called to get clarity on. That's all well and good, but what we need is something where there is actually somewhere to go where we can get a clear, quick, prompt answer. And that's why a program such as ours, I believe, really works, because we can react to that change very rapidly on this micro basis in a case. But any delay brings more arrearage, more issues with the property, more hopelessness, as I referred to it. So when we wait and wait to get clarity, the numbers are rising, and that's going to factor into the numerical formula to actually see if this person can really get.
And getting clarity, you mean from the servicer or from
I mean getting, well, the point is, the clarity, I would think, from the program itself to those who are the stakeholders in it. So if our servicers don't understand what's going on, how can they in good faith negotiate to know all the terms when, in fact, from the consumer side, there's a conflict? And I speak about this in my comments. There's a disconnect of how it's interpreted. Well, that takes time to sort of unravel all of that. That is time wasted on getting this deal done, and now we have more arrearage to deal with in terms of the formula we apply.
Thank you. Counselors, Ms. Fitzgerald?
I'm going to hope Debbie says transparency of NPV, so then I'll say the other thing I want to say. There is a huge process problem here. At the end, there's a lot of good core guts to MHA, but if you dropped from the sky and said, how could you design a more dysfunctional system, you probably couldn't get there. The hours and hours and hours of wasted time, whether that's a homeowner, a counselor, or a legal structure, in trying to get resolutions. Every servicer using different forms for this, everyone having different requirements. While MHA is the same, the paper requirements, documentation is not the same across all of the services.
How important is the web portal? This is Fannie talking as administrator are talking about?
The web portal is a really good first step, because at least we can say some services require fax, some require email, some require mail. So that solves that problem. What it doesn't solve is what gets pushed up into the web portal. And that requires some kind of standardization of documents. In the loan origination process, lots of folks use Fannie documents. That's become a consistent process. So we're saying, come up with one set of documents, every counselor, every borrower. It makes outreach events go a lot better. So that seems very doable. You know, it's not rocket science. Let's just all agree to that and make that happen. And then I think the other piece of the process is really train staff at servicers. And you know, we're very appreciative that servicers have obviously added a lot of staff, which has been required. And that's a huge effort to get everybody on the same page. But particularly on the collection side, I think, you know, a homeowner or a counselor might wind up talking to anyone. And while the loan mod groups seem to be maybe a little bit more informed, it's not clear that that has permeated the organizations. So I think really making sure that everyone there knows this is the requirements.
Give you 10 seconds.
There isn't just one, and I think, you know, that reduces it too far. I want to completely underscore and echo all the comments that Eileen made. I mean, I would say that two things, okay? One is transparency across the board, so that because there are so many issues about the program, because it is a complex program, then we need to know. We need to know what's going on within the NPV model, you know, with the denials for borrowers and the reasons they're given, with the performance data for the servicers. It's the only way that we can really get a handle on where the bottlenecks are, where things are falling apart, is when that kind of transparency is provided. The other thing I would say is, you know, I think we need to be looking ahead more at how the program guidelines are changed to deal with what we can see coming down the road. We are, in many ways, I mean, for all the good things about HAMP, we are kicking the can down the road to the end of the program. We don't have really permanent modifications, right? We have 5-year modifications, and who knows what's going to happen at the end of that. We have an economic climate where unemployment is at an all-time high, or a record high, and expected to stay there for quite some time, but yet we're not allowing for people who redefault to get a new modification or to get a forbearance or whatever might be appropriate. We're kicking them out of the program. And so changes like that, I think, are needed if we really want to get our arms around the foreclosure problem and keep it from overwhelming our economy.
Thank you. My time's expired.
Oh, thank you very much. Well, I wanted to address first a question to Judge Rizzo, because it sounds like your program is pretty interesting, and I look forward to seeing it in action this afternoon. So how are you staffing and supervising this? How many have you taken on more folks who are able to whom you can delegate this, or how does this work?
Well, I always feel like it's the Wizard of Oz. If we move the curtain, you'll see it's one person working all the gadgets. We really are short-staffed in the terms of the court system. We are really an all-stretch assignment, myself and all my staff and wonderful court administrators. So from that perspective, the court is working within its bounds budgetarily. That's not to say it's optimistic, and that, of course, an infusion of some funding in that regard to expand it would be welcomed. But more importantly, we are in true partnership with these non-judicial entities, these community outreach groups who actually go into the neighborhoods, our wonderful housing counselors under the Office of Housing and Community Development and others, our Philadelphia VIP with our volunteer lawyers, our judge pro tems who I appoint, and they work without fee after being trained, as well as we try to support our wonderful CLS and PLA attorneys who actually are staffed up to handle the more complex cases. So from an infrastructure perspective, the money side really goes to the city, and Mayor Nutter, who's in complete support in terms of his message out to call the hotline. We're all in sync. It's really a marriage of judiciary with non-judicial entities to get this thing going. So fueling is clearly always needed for more legal services, more community outreach, increasing our already wonderful staffed up and well-trained housing counselor network in partnership with the courts. So we work on a shoestring from the court's internal perspective, yet we're always, of course, welcoming funding to be with our other partners. So it's a tough network, and I think maybe Mr. Trask can speak to some of that in terms of the funding demands that are placed on it. But we do thank our mayor for trying to really support this initiative.
Most of the funding of the program, the court has managed to, without any increase in funding, to create a program which creates the forum in which all this happens. Most of the funding, as Judge Rizzo said, comes from the City of Philadelphia. A lot of it comes from the Office of Housing and Community Development, and the costs associated with the program, which are somewhat invisible. And one of the, I guess, problems with this is that this model has been advocated as a cost-free model. It's all volunteer. And in the court side, that's true. The JPTs are volunteer. There are a lot of volunteer lawyers. But in fact, there's probably $1 million, there's actually several $1 million that goes in to, there's probably a total of about $3 million that goes into the costs of funding the hotline, funding 32 housing counseling agencies, funding outreach, although the amount of funding for outreach is actually very small for the bang for the buck. So there is a significant cost, and that cost is borne by the city in creating the structure, the infrastructure, which needs to be there to have a meaningful program such as the diversion program. You have to have housing counselors. You have to have some way for them to get to the housing counselors where the hotline comes in. The hotline, as I indicated in my testimony, serves something of a coordinating function. And there's a feedback loop that's created with the hotline. So you need all these things. And also, in a lot of cases, you need the one thing that's missing, which is beyond the volunteer attorneys who get involved on a limited basis, is lawyers to actually step in and represent people when the lenders, and it is not unusual, when lenders overstep their bounds and ask for things that they're simply not entitled to.
What kind of backlog do you have, caseload right now?
Just very quickly, when we're in session, we hear approximately 150 cases in the morning and 150 in the afternoon. They're called in. We have no backlog in the sense in that regard. Philadelphia has seen a bump and increase, of course, in foreclosure filings. It's leveled off, and we anticipate another bump. So we're at about 10,000 filings per year just in foreclosure. That has been 2,000 jump up from the years past. But in terms of backlog, we're in flow, and I think we estimate about 140 or 50 filings per actually that's by one firm, so I don't know about how many filings per month. We're steady in that regard, and there is no backlog because of initiation. They immediately go into the chute, and they're scheduled for the 45-day conference. Pre-trial. I might also add, just to the other point, almost $1 million in pro bono services have been generated and given to support this program. So that's daunting, but it is actually dedicated volunteer service.
Just one of the kind of unadvertised benefits of this program is that to the extent that there are resolutions that are reached, it takes cases out of the inventory of foreclosure cases that need to be tried by the courts. So that is a benefit. That is a benefit that the court experiences. To the extent these can be taken out of the system early, that's a benefit to the court that saves time and money.
Thank you. Mr. Silvers.
Well, like my fellow panelists, I'm pleased to have you all here, particularly pleased to have Judge Rizzo here, honored to be with you, and we're certainly coming to visit. Let me just make sure I heard the testimony right. Judge Rizzo, you said that you've had 6,300 conferences and 1,500 homes saved, roughly, from foreclosure, is that?
Yeah, that's right. I mean, we can go on and on a debate of, well, how do you describe success? Because from the court's perspective, when it's out of the system, those are the 1,500 because the case has been closed. We're judicial.
How many of those 1,500 have come back?
Well, that's the point, and that's where the data has been. How do you measure success? And so time has to pass, in effect, for us to go back and revisit that. And we're very grateful that National Foundation has come calling to really break down our data and give us that kind of critical information.
So at this time you don't know?
No, we do not.
Okay.
No. We're dinosaurs. We're not very good about collecting our data.
I would note that the kind of cost figures you're talking about in the prior exchange, 3 million, 1,500 homes saved, is comparable to the servicer fee that is being paid under the MHA program per mortgage, which is only a small portion of the total cost in the MHA program. Can I, moving forward from that, Mr. Traus, when you say that MHA should be mandatory, what do you mean? MHA is mandatory in the sense that participating in the program is mandatory for TARP recipients, more or less. Tell me what you mean by mandatory.
Before I answer that question, could I answer Mr. Nyman's question about the one thing that should be done? And
Please.
that is the administration needs to get behind passing the amendments to the Bankruptcy Code to allow for mandatory modifications. If that happened, if that was real, that a bankruptcy court could modify these loans to make them affordable, everything else would fall into line because the creditors would want to avoid that, and they would be looking to a program that had incentives for them to make the changes that benefited everybody. With respect to mandatory, I mean, Participation, if you sign the participation agreement, then you're supposed to follow the rules.
Right.
But there's no teeth. So I guess by mandatory, I mean some system where there is immediate consequences for failing to do what you're supposed to do.
Aren't you, maybe I'm not following, I mean, law is big and complicated, right? Maybe I'm not following this, but it seems to me that a firm that signs that agreement, receives TARP funds, right, has entered into an arrangement with the federal government where they're receiving money for making commitments and adhering to them. And in our law, there are really serious penalties, including criminal penalties, for intentionally not following such an agreement. Isn't that right?
Well, I haven't looked into I assume that you're correct about that. What I know is that on the ground, day to day, and you may be right, that 5 years from now, there will, just like with this...
No, my point is just that maybe we have an enforcement problem here and not a lack of penalties problem.
Well, we have an enforcement problem, but that's exactly my point. I mean, it's not a question of penalties, because penalties down the line do not help the hundreds of thousands and millions of people who lose their homes. For example, Bank of America, I don't know if they're here yet. Bank of America, until I think August, in Philadelphia at least, were telling our hotline people that they signed the SPA, but they were only doing GSE loans. They were not offering MAP or MHA or MAP on HAMP on any non-GSE loans. There was like 4 months. Thousands, millions possibly, but thousands, tens of thousands, perhaps hundreds of thousands of people were not being into the system. Their houses were going to foreclosure. They were losing their homes because Bank of America was blatantly, as far as we can tell, violating their obligations under the contract. And we contacted Fannie Mae. We contacted Freddie Mac. And the response we got from Freddie Mac was, yeah, we know.
You may have noticed, Mr. Trauss, I don't know if you were here earlier, but I asked the Treasury Department to review your testimony in relation to allegations, seem to be plausible allegations of misconduct, and to report back to our committee as to what they found. Can I ask a sort of a silly question? Judge Rizzo or Mr. Trauss, you may know the answer to. When your outreach people go knock on a door, and they knock on the door, and the person says, "Who is it?" What do they answer?
Well, I am not directly involved in the outreach. I don't know if anybody from some of the agencies that do are here. So I can't answer exactly what they say. We do get the calls when the outreach workers, we try to coordinate with the outreach workers so that we are there even on weekends.
I assume they don't answer, it's your bank calling.
No.
No.
Yeah.
All right. I hope that the record taker here could hear that response from the audience.
That's Lance Haber from the city, so.
I'm sorry.
They identify themselves from the organization that they are with. So if it's ACORN, it's the MOP, there are different organizations that are doing the outreach.
Thank you.
Thank you.
My time has expired.
We're going to try to do one more round. We're running a little behind, so we'll really try to keep these within our timelines. I'd like to go back to my first line of questions to the Treasury panel regarding their metrics of success, because it is currently focused on trial modifications. And as you all know, some trial mods are based on are offered and started before a verification of income based on verbal information, while others, servicers, do wait to verify that documentation before starting offering a trial mod. Do you all have any views as to whether either of those approaches is preferable?
My view is that the oral implementation, well, let me say this. I have no problem with the oral implementation, and what I find happening is that anything that reduces the excuse that a servicer can give for not immediately saying, yes, we will consider you, we are stopping foreclosure, start sending us money.
So as soon, right, to the earliest you can to get people into...
Right, that is the best thing, because it doesn't take long. The paperwork that is required by HAMP is very minimal. Now, the servicers add to that paperwork, but the HAMP paperwork is pretty minimal. And that's pretty easy to get into. And what we find is that the paperwork requirement is used as an excuse to frustrate the ability of people to participate.
So how about from the counselor's standpoint?
I think it would be important to track those two numbers differently. So I wouldn't disagree that you should give the borrower the modification as soon as possible. But when someone's going back to look at success, I guess I'd want to know, was there a difference in those? Because I wouldn't want folks to say this program didn't work because of stated income. So I think it's really important, if we're going to do that, to track separately.
I would also add to that I think a second and related but important question is the servicer's ability to handle the paperwork and review it in the time frame that's provided by the program. So in my testimony, I cited an example of a client we had recently in Mississippi who was one of the early, got one of the early trial modifications. She got it based on verbal information provided to the servicer. She made her first payment under the trial mod in April, the beginning of April, and at that time she sent in all of her documentation. Unfortunately, she did it without consulting with our counselor, so she got some of it wrong. Like she didn't sign the tax return that she had submitted electronically originally to the IRS. 5 months later, she's made 5 payments now, so that's 2 beyond the end of the trial mod, and the servicer, who was Chase, contacted her and said, none of the paperwork that we have, it's either missing or it's invalid, and if you can't get it to us within 60 days, you lose your shot at a modification. And so this is a servicer who had this paperwork for nearly 5 months and couldn't get through it in a timely fashion to give the borrower the opportunity to correct the errors in the, in
So
the
how big is it? And we keep hearing documentation we hear it from the servicers because they're saying the individuals are not providing back signed documents. We hear it from the counseling agencies that the documents are either lost or not being presented in a timely fashion. How big on a 1 to 10 scale is documentation?
Big.
Huge.
Yeah. But again, it's the system that they haven't set any efficient system for collecting
Okay, so it's system,
and making this standardized documentation. That is, to me, the bigger problem.
And as I think earlier testimony alluded to, one of the things counselors struggle with is that the servicers are constantly changing the system that does exist.
Okay.
So you're getting a new phone number, a new fax number, a new email address to send stuff to all the time. And so you thought you knew how to do it efficiently until you get the new policy, tomorrow.
So with my last minute, you may have been here when I asked the government panel to assess the performance of the servicers using a school grade of A to F, recognizing that this is a first semester as opposed to a year-end review. I'd be very interested in your assessment of how you would grade servicers as a whole.
And my solution when I heard that question was incomplete.
Well, that's fair. And others?
Well, I would, with some qualifications, I think I would have to say a D, and that's for 2 reasons. One is that I don't think we're in the first semester.
Okay.
This problem has been going on long predates HAMP, and servicers for quite some time have been saying that they've been ramping up, and we're not there yet. So I don't think we're in the first semester. The second thing is, my kids' teachers send home a little rubric to grade them by. These are the things we're going to judge, and effort doesn't count towards your grade. It's, what you actually have mastered and can demonstrate that you master, and, the servicers just are not there yet. They may be doing a great effort, they don't have it mastered.
Judge Rizzo or Mr. Strauss, fair to weigh in?
I concur.
Great. Thank you very much.
I'm going to refrain from any grading, but I just want to say, with all parties to the table, we really need this in terms of simplification and making it an easy read for everyone. That's also going to benefit our borrowers who sometimes, part of the delay is caused by them even coming up to get it all together. So
Right.
I have to, as the court, balance that. This simplification, this easy read will help those wonderful housing counselors and other those who assist in the process get it in the chute so then it can be evaluated for the services. Hopefully we're all on the same page.
Thank you. Out of time?
Thanks. I wanted to ask the panel, especially here in Philadelphia, what you all estimate the percentage of non-standard loans might be as part of this problem, the Alt-A's and subprimes and no-doc loans, those sorts of things. Is that what's really driving this, or do you see this throughout all parts of the population there.
And when you, well, I'll just start. What I'm seeing coming into the program consistently is not necessarily the subprime. Obviously, it exists to some degree, but that's not where we are. We're a city of, old historic city, Philadelphia row homes, individuals who've been in their homes for many, many years. Our demographics show that our program really assisted the elderly and single parents, moms, that we're looking into that, and we actually have special protocols to deal with their very special needs. But it's the situation at a law school where someone wants to put aluminum siding on your house, knocks and says you need it, they get into some loan situation, non-payment, or they run, it gets converted into some mortgage document, and then here we have a lien, and now we're here if someone's in a home 35 years and about to lose it. So I see sort of these anecdotal stories, not necessarily of the massive subprime. We're not the Sun Belt with these new people buying these mansions and being underwater immediately. That's not what we're seeing. So this consistency of need in what I'm seeing coming into the room is not of that ilk.
I would, I guess, have to disagree with Judge Rizzo to some extent.
And he always does.
Not always.
That's the point about me.
There's a combination, and it's been a moving target. I mean, to some extent in Philadelphia, I think the subprime crisis, which was directed much more to low-income homeowners, kind of peaked in 2004. But subprimes did increase the foreclosures to the level of from like 6,000 a year to close to 9,000 or 10,000 a year. Perhaps last year. At this point, we are seeing unemployment as a huge component. Unemployment, underemployment, people lose their jobs, get their jobs back, lose their jobs again, get another job. So there's a shifting face in what we're seeing. And now remember, this is a case, this is a program which looks at cases in which complaints of foreclosure have been filed. And also in Pennsylvania, the time to get to foreclosure is somewhat long relative to other states. So the foreclosure rush that's resulting from the unemployment increase, I don't think has yet hit the diversion program to the extent that it might have hit other places because it's a lag of probably about 5 months before a case actually gets to a complaint foreclosure. So what we're seeing is a change in the composition of the majority of what's causing the foreclosures, and it's moving more toward unemployment.
In general, across the country, I can't find the percentage, but our counselors serve many higher percentage of folks with ARM than are in the population. So I think it's probably 35 to 40%. But that said, there are a lot of prime loans in this mix, and a lot of families who particularly, and we see each time that percentage increases and problems with income increase. I do think that we have a really big challenge with the option arms coming on, particularly in California. They're very concentrated, but they only peak in 10 and 11, and they're going to present a totally different problem. I do know that Treasury seems to be aware of that and thinking of different strategies.
I can't speak at all to the numbers in Philadelphia. I can tell you that in Louisiana, it's a kind of different situation. We still see a mix of different loan types, and thinking of what I've heard from NAFA's members around the country, I think it varies a lot depending on the particular local market. In the Midwest, it's a little bit different than in some of the sand states. But I think everybody is seeing unemployment as an increasing factor, regardless of the loan type. But we're also still seeing the troubling loan types. I'm sorry.
I just want to also talk about the troubling loan types. In Philadelphia, has historically had a high percentage of its low-income population owning homes, and that was going up for a while. And one of the problems is it's not always obvious what the loans are. Some of these loans, if you look at them, look like first mortgages. Traditional first mortgages, but if you look closely at them, you find out that they are predatory or unfair. They have high interest rates. They might be part of an 80-20 loan where a person bought a house with a first mortgage and there's a second mortgage they didn't really understand for 20%. That's a high interest rate mortgage, which makes the total package unaffordable. Unlike normal loans, escrow is not included, so that when they start getting the payments, there's this shock that happens as the tax rates go up and they didn't realize that it wasn't a traditional loan. So that from the court's point of view, it would not necessarily be obvious that the particular loan involved is of the kind that, you know, that we're trying to break out. I mean, there's a lot of sort of, I guess I would call them unfair loans that are in there, along with traditional prime credit and also these exotic loans with adjustable rates.
Thank you. My time is up. Thank you.
Mr. Silvers. Thank you. When my last time expired, I was asking about how the outreach is conducted. Is it your view that having outreach conducted by parties other than the banks has contributed to the success of the program, either Judge Rizzo or Mr. Strauss?
I can tell you, I believe it's been a significant benefit to have this type of canvassing done by neighborhood groups who are known in the community, who have the way to engage and actually have a level of trust infused in the dialogue, where they knock on someone's door, and it's not someone serving papers, it's someone saying, listen, I know who you are. You're in foreclosure, right? Did you get your papers? Did you look? Did you see your date? Make the call. If there's issues with language, we even have abilities through our hotline to deal with those types of issues. So that outreach, that one-to-one human touch by people in the community, I think they really started. And actually some studies were done where we took some batches of our cases coming in, subject to canvass and not, and we saw that the failure to appear rate was higher in those which were not contacted through canvass. So we really have some experience with this to know that it really does make a difference, and I think it really is a key in terms of our local program.
Thank you. I want to shift to a much broader question. There's a certain amount of dissatisfaction on this panel, and I think on the last one in a somewhat more moderate way, with the servicers. Any of you, what is happening here? Is this disorganization? Is this intentionality? Do the servicers wish not to participate? And if so, why?
Well, I think it's really hard to aggregate a group of organizations, so we have to be careful in that.
Well, then let me help you. I mean, I'm just interested in volume, right? If you look at the Treasury reports, monthly reports, there's a half dozen, I think, that constitute almost all the volume, right? I mean, not just the volume of the mods, but the volume of the underlying loans. Let's talk about them.
I do think that the mergers have created maybe, even unanticipated consequences because they have many servicing systems. They have different procedures. So I think we've certainly seen probably a decline in responsiveness and just their ability to solve escalated problems due to the consolidation. I think at a leadership level, we have a lot more responsiveness, honestly, than maybe we did 3 years ago about awareness of the problem across the senior leadership. Obviously, there's a challenge in execution.
And one thing I would just add to that, I can't speak to intent, but I think we should be mindful of the incentives that are built in for servicers to move towards foreclosure and how those compare to loss mitigation. And the attorneys on the panel can probably speak to this better than I, but the feedback that I get from the lawyers that I work with is that servicers get paid more, they get paid faster, and they get paid more reliably for all the steps that they take to move somebody towards foreclosure than they do for loss mitigation.
Ms. Goldberg, can you stop right there?
Yeah.
All right. Is that still true today with the MHA program being in place?
I believe it is.
What could be done to the MHA program, and I invite any of you to comment, that would alter that fundamental calculus, and not getting into the deeper questions of, the fundamental economics of the loan, but this question of servicing and where those incentives are.
Yeah, there's a big problem with the incentives. I mean, there's like four problems mainly, and which relate to your question. I mean, I think there's a problem of culture, which is very hard to overcome. There's been a way of doing things since these servicers were created, which is now, I guess, I don't know, about 10, 15 years ago, became big. They have a way of doing things. They have a mindset. It's our way or the highway. And they're not used to changing that mindset, and that's a big problem, and that relates to habit. And then there's the incentive problem, and to answer your question, we can't answer your question, at least I can't without further study about the nature of the incentives. But my suspicion is, my gut is, that the amounts of money involved, even at this level, are not big enough to overcome the cultural problems, the habit problems, the disorganization problems, and the existing incentives to foreclose.
Yeah, can I stop there for just a second? I mean, you and I have both stated that we think that restructurings and bankruptcy would help here. From what you just said, might another different approach be to, and this is more like a sort of a business approach as opposed to a legal approach, to ask, essentially to get subcontractors who do nothing but this, that specialize in formatting loans, if we've got profound cultural problems with businesses that have been built to do something different?
The problem with using subcontractors, as evidenced by the last opinion of Judge Sigmund, the bankruptcy judge, one of our last opinions, talks about how, theoretically it could work depending on how you select the subcontractor. Sometimes if you select somebody to do a narrow thing, they don't do it with the right understanding of
well,
the
they might
overall.
not have the resources, they might not have the broader capacity that the large banks and their servicing facilities have. Is that what you're suggesting?
Well, what I'm suggesting is the extent that loss mitigation, to the extent loss mitigation has been farmed out, which it has by these services already, even before making homes affordable, it has not enhanced the process.
Thank you.
And I don't know why that is, but doing exactly what you do, hiring a subcontractor to do something repeatedly and efficiently, has not made things better, it's made things worse.
Thank you.
It's just
My
created
time's expired.
disconnects.
Thank you. I want to thank you all for being here this morning, but even more importantly, I want to thank you for what you do every day. And I look forward to the afternoon with Judge Rizzo, and I will even look forward to staying in communication with you. And please keep us advised as you update your data and look at us as a resource as well. Thank you very much. So let's try to change panels as quickly as possible because we are running a little behind. No, we're gonna have questions and public comments at the end after the next panel.
Alan Jones, Bank of America. Good to see you.
Paul William, Boston Fed.
Yes, sir. You know exactly who you are.
You do?
Watched you on many occasions.
I was on vacation, and I was in a coffee shop, and I was talking on the phone with someone. And some guy at the next table said, I couldn't help but overhear him.
Directly, that's,
Service incentive?
they're saying that services have more incentive.
Oh, right. Yeah. Oh, that's a good point. Yeah, do they? Yeah, that's a good question.
Never thought I'd get any attention.
Started. I guess that was a little seventh inning stretch there. The witnesses, and this is our largest panel, so we really do have to be conscious of the time. The witnesses in our third and final panel include three servicers and an economist from the Boston Fed. From the left, we have Dr. Paul Willen, senior economist and policy advisor at Research Department at the Federal Reserve Bank of Boston, who has been writing and researching this for many years and well known to many of us. Alan Jones, Senior Vice President of Default Management with Bank of America Home Loans. Larry Litton, President and CEO of Litton Loan Servicing. And Joe O'Hayon, Vice President of Community and Client Relations for Wells Fargo. I very much appreciate you all being here. I know these are tough environments for you all. I know you all travel and have come great distances. But I think this is very important. I am glad. If we couldn't get Treasury to sit to the end and listen, I think I am even more importantly, that we have the servicers sitting and hearing those prior panels. So I looked forward to your opening statements and to the question and answers, and please do try to limit those within 5 minutes. Thank you. Dr. Willen?
Thank you. Mr. Atkins, Mr. Neiman, Mr. Silvers, thank you for your invitation to testify. My name is Paul Willen, and I'm a senior economist and policy advisor at the Federal Reserve Bank of Boston. I come to you today, however, as a researcher and as a concerned citizen, and not as a representative of the Boston Fed, the other reserve banks, or of the Board of Governors. Over the last 2 years, we have searched for policies to help troubled borrowers avoid foreclosure. In New England, we at the Boston Fed have worked with banks to set up a lending facility to help subprime borrowers refinance into prime mortgages. We brought borrowers and servicers together in large-scale foreclosure prevention events that have served as a national model. In the research department, we have gathered and analyzed detailed loan-level data to help us evaluate policies to ameliorate the effects of this crisis on our communities and on the country. In my remarks today, I would like to focus on 3 aspects of the foreclosure crisis relevant to foreclosure prevention plans. The first is that an effective plan must address the problem of unemployed borrowers. Long-term loan modifications that yield affordable payments for borrowers but also provide attractive payment streams to lenders will help some, but they cannot help unemployed borrowers. 31% of an unemployed person's income is often 31% of nothing, and a payment of 0 will never be attractive to a lender. And this is important because our research shows that, contrary to popular belief, unemployment and other life events like illness and divorce, much more than problematic mortgages, have been at the heart of this crisis all along, even before the collapse of the labor market in the fall of 2008. This may seem counterintuitive. Life events could not explain the surge of defaults in 2007 because there was no underlying surge in unemployment or illness that year. But that view reflects a misunderstanding of the interaction of house price depreciation in life events in causing default. When prices are rising and borrowers have positive equity, detrimental life events lead to profitable sales. But when prices are falling and borrowers cannot pay off their mortgages with the proceeds of a sale, those life events lead to foreclosure. Thus, we did not need to see a surge in life events to get a surge in foreclosure, but rather a fall in house prices, which is exactly and unfortunately what we saw. The second policy-related finding from our research is that it is unlikely that a modest financial nudge to servicers will lead to millions of modifications that will help millions of worthy borrowers. In a recent paper, we showed that in the period 2005 to 2008, lenders gave payment-reducing modifications to only 3% of seriously delinquent borrowers. In addition, we showed that this did not result from contractual issues related to securitization. Lenders were just as reluctant to modify loans when they owned them as when they serviced them for securitization trusts. We argued that the main reason we see so few modifications is that it simply isn't profitable for lenders. Modifications benefit lenders because it helps avoid the high costs associated with foreclosure. But redefault risk, the possibility that the borrower who receives a modification will default again, and self-cure risk, the possibility that a borrower would have repaid the loan without any assistance from the lender, can wipe out these benefits. The role of self-cure here is key. About a third of the borrowers in our large sample are current on their mortgages or prepay a year after they become 60 days delinquent. An investor would view assistance given to such borrowers as wasted money. The third result from our research is that policymakers need to exercise care in designing foreclosure prevention policies that provide the right incentive to borrowers and servicers. A program that offers monetary incentives to do as many modifications as possible and to minimize the probability that modified loans redefault may not, in fact, prevent many foreclosures. To see why, one must realize that the easiest way to ensure that a borrower doesn't redefault is to choose a borrower who was unlikely to default in the first place. Thus, a servicer could make minor modifications to millions of loans to perfectly creditworthy borrowers, collect large sums from the government, and then collect even more as the borrower continued to repay the loan. Taking these research results into account, we believe the most effective use of government money for foreclosure prevention would involve direct assistance to borrowers rather than to servicers. 2 recent proposals, one authored by a group of Federal Reserve economists, including me, and the other by researchers at the University of Wisconsin, target the unemployed to help them cover their housing expenses until they get their feet back on the ground. Either plan would prevent large numbers of foreclosures and would be a good starting point for an effective foreclosure relief plan. We hope these findings add perhaps unexpected insights to your work as policymakers, and thank you again for the opportunity to appear before you today. And of course, I'm happy to answer any questions.
Thank you. Mr. Jones.
Superintendent Neiman, Mr. Silvers, Commissioner Atkins, My name is Alan Jones, Bank of America's Default Management Executive. I appreciate the opportunity to appear before you today and provide you an update on Bank of America's efforts to keep our borrowers in their homes. As the country's largest mortgage servicer, we are a major partner in the administration's Making Home Affordable program, and we understand the responsibilities that are associated with that leadership role. We are committed to helping the administration achieve its goal of 500,000 trial modifications by November 1st. Bank of America is working to transition 125,000 at-risk loans into trial modifications as part of this goal. As a demonstration of our growing momentum, in August we doubled the number of trial modifications that have been started, and based on our most recent reporting, I can tell you that we now have 81,000 borrowers in trial modifications. Throughout this historic downturn, Bank of America has extended credit to drive economic growth and work to develop financial solutions for our customers. For example, we were one of the first lenders to leverage the administration's MHA refinance program, and to date have completed refinancings under the program for more than 74,000 borrowers. Earlier this year, Bank of America began reporting on how it continues to lend and invest in the communities we serve. In our second quarter report, we stated that through the first half of this year, we've extended more than $394 billion in total credit, more than $196 billion in first mortgages, $40 billion in low and moderate income mortgages, provided more than $8 billion in small business, and $149 billion in commercial non-real estate loans. We will continue to provide transparency into our lending and investing efforts and anticipate our next report on third quarter activity will show continued leadership. We understand the decisions we make have broad implications, even beyond our customer base. Recently, Bank of America announced we have created a new position, Consumer Policy Executive, a role which will work directly with our core consumer lines of business to ensure that viewpoints from key external stakeholders, including community groups and consumer advocates, are taken into account as we address policy issues critical to our customers. We're leveraging lessons learned from this economic crisis as well as input from customers to improve and strengthen our products to better meet consumer needs. At the center of that work is our commitment to simplicity and clarity, developing straightforward products that are easy to use and have clear terms. As described in my written testimony, my teammates on the credit card and deposit teams have also recently announced exciting new innovations. The focus of today's hearing is on what we are doing in the market to keep Americans in their homes. Before MHA, we were one of the first lenders to implement a national home retention program. Through that program and other efforts, Bank of America completed loan modifications for approximately 190,000 customers from January through mid-September of this year. That's in addition to more than 230,000 for all of 2008. We are now working hard to help ensure MHA's success and have established a sizable infrastructure to handle customer demand and program details. Significant resources have been devoted to this effort, including expanding our default management staffing to more than 11,000, a 55% increase since the beginning of the year. Our recent results reflect our conversion to MHA as the centerpiece of our home retention efforts. As a result, we have significantly increased our trial modifications from approximately 28,000 in July to more than 81,000 through mid-September. In that same period, we have also increased the number of offers extended under MHA to more than 141,000. Importantly, as we have ramped up, we placed on hold any foreclosure sale. With that said, we continue to look critically at our loan modification process. Three areas of particular focus right now are how we can make the process more customer-friendly and responsive, how we can more efficiently handle customer documentation, and how we can keep customers better informed throughout the process. In addition, there are other challenges we continue to confront in our efforts to help as many borrowers as possible realize the benefits of MHA. In an effort to improve our outreach and close these gaps, we have ramped up activity through traditional avenues such as mail, telephone, and we've escalated our participation in community and outreach events. Since January, we have participated in more than 167 community outreach events and will be here in 2 weeks in Philadelphia. We also have partnered with 3 national nonprofits. I heard earlier in the panel the importance of a trusted advisor. So we've partnered with 3 national nonprofits in the creation of the Alliance for Stabilizing Communities. There are limits to what the current programs can achieve. Unemployment, lack of interest in maintaining a property, those are issues that we have to consider. And as I wrap up my written oral statement, I'd like to focus on the fact that we really understand the urgency here. The strong focus from the administration has added substantially to our collective efforts to assist homeowners. Yet we understand we have a long way to go in very challenging circumstances. We look forward to working with the administration and the Congress. I appreciate the chance to be here.
Thank you. Mr. Litton.
Yes, sir. Well, first of all, I would just like to thank you for the opportunity to be here. And if many of you can't tell, I'm from Texas. I'm the funny sounding guy up here. So, I am very excited to have this opportunity to kind of share some insights with you. I am responsible for running a mortgage portfolio of about 365,000 loans, about $58 billion worth of mortgage product. We're in all 50 states. It's predominantly subprime as well as Alt-A product. And at Litton, we've been a leader in providing workout solutions to homeowners for more than 20 years. We have been and we continue to be a proponent of thoughtful as well as practical loan modifications that provide affordability opportunities to struggling homeowners, and that is very consistent with our obligations to the owners of those loans. We're very proud that many of our early strategies serve as the basis for many of the loss mitigation methods that the industry deploys up to this day. Over the past 12 months, or in the 12 months prior to the announcement of the HAMP program in February, we had modified more than 44,000 loans over that 12-month period of time. That represented about 30% of our serviced first lien mortgage portfolio that were 60 days or more past due. On average, these modifications lowered the homeowner's monthly principal and interest payment by about 20% based off of how those loan modifications had been structured. Since March of 2009, when the initial HAMP guidelines were published, and up through August of 2009, when Litton had signed up for HAMP, we had extended trial modifications to approximately 40,000 additional homeowners. These trial modifications were offered in accordance with the broad principles of the HAMP guidelines. Since signing on to the program in early August, we have offered another 10,000 HAMP loan modifications. So when you add all that up, we got 44,000 loan modifications that we had done in the 12 months leading up to February, 40,000 trial modifications over that time frame from February up until we signed on to HAMP, and then 10,000 additional loans that we'd modified under HAMP, makes up a total of about 25% of our total portfolio that we service has been modified over the past 18 months. So having said that, I'm here today to kind of offer a couple of suggestions as it relates to the HAMP guidelines. HAMP has very successfully created substantial momentum in the mortgage servicing industry by providing more loan modification opportunities to struggling homeowners. But as with any government program, there are some lessons that I think that we've learned, and there's 4 suggestions that I'd like to kind of make here today. The first suggestion has to do with debt-to-income ratio. So the 31% debt-to-income standard is a very reasonable basis to calculate a modified mortgage payment. However, I'm going to give you an example. There are homeowners who have substantial arrearage that has built up, and that arrearage was built up because a borrower may have had a prior unemployment situation or other life event that may have created an instance where the borrower got past due. In those situations, they may have a front-end debt-to-income ratio that's less than 31%. And then after capitalizing arrears or forbearing the arrearage, you may create a situation where the payment may go greater than 31%, but those borrowers would be excluded from HAMP. So expanding HAMP to include situations where borrowers have less than 31% debt-to-income ratios, in those instances where arrearage had been created, might be a worthwhile way for policymakers to consider expanding the program to be more effective. From an income documentation perspective, it's completely understandable for a program that relies on taxpayer funds to require lots of income documentation. However, I would say that there are delays that are created by requiring some of the documentation that we do require. The earlier panel made reference that in many instances that is not a lot of documentation. I would agree with that. However, I would state that it is a problem in many instances on getting that information from some of these consumers. So I think a way to streamline that, if policymakers could consider streamlining that might make the program more effective as well. As it relates to the NPV model that the GSEs rolled out, The NPV model was based on state averages of home price depreciation and is not often granular enough to take into account home price appreciation or declines within specific communities and neighborhoods. This will cause some loans to fail or some loans to pass the NPV test when they potentially should not. Our experience has found that more loans fail than what should actually fail in those situations because the data is not granular enough. So being a little bit more specific as it relates to NPV models might also be something for policymakers to consider as well. And then the last point I'll make has to do with option arms. Your prior panelists made reference to a point, I think they're exactly on point, that there is a coming wave as it relates to option arm loans, and many of those loans will not fit within this program. So policymakers considering ways to expand the program to make it more focused on option arm product might be something very worthwhile as well. Thank you very much. I'm happy to answer any questions that
Mr. O'Hayan.
you might have. Thank you.
Thank you. Members of the Congressional Oversight Panel, I'm Joe O'Hayan, Senior Vice President of Community and Client Relations for Wells Fargo Home Mortgage Servicing. Thank you for the opportunity to speak before the Oversight Panel today. We take seriously the responsibilities that come with Treasury's investment in Wells Fargo through capital purchase program, and we're committed to do everything we can to assist struggling homeowners as part of the responsibility. Wells Fargo may be a big corporation, but we operate within the conscience of a company determined to do what's right for our customers, our investors, and all American taxpayers. Of course, this year, much has changed and evolved in our economy and in our efforts to assist struggling borrowers. First, we worked hard to implement the very detailed and evolving home affordable modification programs, which include different guidelines and requirements for Fannie, Freddie, non-GSE, and most recently FHA borrowers. To handle the greater than 200% increase in borrowers requesting assistance, including the 35 to 40% who are current on their mortgages, we have hired and trained an additional 4,600 U.S.-based home retention staff for a total of more than 12,000. As of September 3rd, we have qualified more than 304,000 customers for trial and completed modifications this year alone. As it pertains specifically to HAMP, we had offered 78,000 customers a trial modification, and we received at least the first payment for about 44,000 of those trial modifications. We have further enhanced our support systems, our training, and our retraining to aid our service representatives in appropriately communicating modification programs and guidelines as they continue to change and expand to help more borrowers. In addition, we have improved the ways to obtain from borrowers the extensive documentation the government requires for its programs, and we continue to work to ensure all documents are processed in a timely manner. And most importantly, in this dynamic environment, we continue to conduct a final review to ensure every option is exhausted before a property moves to foreclosure sale, because when a foreclosure occurs, everyone loses. Despite widespread decreases in home values, more than 92% of our customers in our entire servicing portfolio remain current on their mortgage payments. This is a direct result of our customers' efforts and our commitment to responsibly service all the loans in our portfolio, including those formerly owned by Wachovia and loans we serviced but did not originate. In addition, our delinquency and foreclosure rates continue to be significantly lower than industry average and the lowest of the nation's largest mortgage lenders. And for all 2008 and 2009 year-to-date, less than 2% of the owner-occupied properties in our servicing portfolio have actually proceeded to foreclosure sale. These results would not have been achievable without the continued collaborative public and private sector efforts to inform customers of their options and the introduction of the new home affordable modification programs. While we're proud to be part of the HAMP development, it's an important option. It needs to be acknowledged that HAMP will not help all borrowers in need of payment relief. For the customers who are ineligible for HAMP and where we can reach affordability, we offer customized solutions. You've also asked us for our feedback on Philadelphia's residential mortgage foreclosure diversion pilot program, and I'm happy to provide you with a few comments based on our experience. In general, we found that intervention programs like Philadelphia's can be helpful when they allow a servicer to engage in a discussion of alternatives to foreclosure with borrowers that have not yet had such discussions with us. Anytime we have the opportunity to work with a borrower that we have been unable to reach or to have a deeper discussion with a borrower, we open up the possibility that we can find a way to avoid a foreclosure that otherwise would have occurred. From our perspective, Philadelphia's diversion program is one of the most streamlined and cost-effective programs of this kind, and provides intervention in a way that can be helpful to the borrower without being overly burdensome on the servicer. Conferences are scheduled in a relatively short time. Servicers can participate by telephone, key steps in the foreclosure process can proceed in parallel with conciliation process, and the standards for evaluating whether or not foreclosure can be avoided are relatively clear. The city also has done a good job of adapting its program and making adjustments to lessons learned. In terms of ways to improve the program, we find that some homeowners for whom a conference is scheduled fail to attend the conference, and a limited number of borrowers come out of the conciliation conference with a potential for a workout solution. If the city can provide some means of limiting the conferences to only those borrowers who have not been fully evaluated for possible alternatives to foreclosure and those who are actively engaged in the process, the resources required on behalf of the city and servicers could be significantly reduced, and the customers who can truly benefit could still be served. As servicers, we sit between the customer and investors, and we are responsible for doing modifications the right way. We also have a responsibility to execute these programs well for all American taxpayers by ensuring that customers given modifications are truly facing hardships and that they can afford and sustain their home payments after modification is completed. Thank you, and I look forward to your questions.
Thank you. Thank you. I started off my questioning of the Treasury and GSEs by pointing to the success metrics that the Treasury has been using to evaluate the success of the program, and also to establish performance among the various servicers. And as you all know, there's great disparity between performance, with some down in the 0%, with others up in the double digits. Recognizing that some of these disparities may be due to the timing on when servicers enter the program, or based on the type of trial modification. Is it based on verbal information, or have they waited for full documentation? I'd like your views on what is the best way to analyze this information, and should there be changes in how we implement or look at trial mods? Open up to whoever. Larry, you seem to be nodding.
Sure, I'm happy to start. So, as it relates to whether we start with a verbal or a written, I 100% concur with the statement that was made earlier that the most important thing is to get moving whenever we have a customer on the telephone. So we're of the view that proceeding with verbal information is critical so that we can stop the foreclosure and so that we can begin the process of the loan modification. So we're very supportive of that. However, that does bring up challenges later in terms of making sure that you follow up with getting the income documentation that we have to have. But I do think that that's one area that could be driving substantial disparity, is the fact that some may be waiting for the written information to come in before they start the trial.
Yeah, I would agree with Larry. We've done it both ways at Wells Fargo. The program has evolved over time. It was initially announced in February, and certainly has gotten better and more refined as the months have gone on. Things like the rollout of FHA HAMP in late July, and which went live in middle of August, certainly helps a servicer like Wells Fargo because we have a strong concentration of FHA loans. But we started with fully underwriting and requiring proof of income and documentation up front, and has since moved to a verbal approach. It provides immediate relief to the customer because we can grant a trial payment and reduce payments immediately. But as Larry points out, certainly it provides the opportunity that once we get supporting documentation, it may exceed that level or be under the level of income that we actually got from the customer.
Thank you. You know, I'm also interested to the extent that the program has restricted your ability to offer loan modifications or outside of the program. And I would particularly like to start off with Mr. Litton, because he, to my understanding, was one of the few servicers that had been utilizing principal reduction as a favored loan modification. And the fact that HAMP does not prohibit it, but it doesn't require it, but permits it, but doesn't require it. Do you have a view on whether this is making it more difficult for principal reduction, and is that something that the program should be reconsidering?
So I testified back in November in front of Congress on this issue. We adopted a policy in November of 2008, ran that policy up through March of 2009 that did support a full principal reduction strategy. That was based off the fact that our analysis at that time had concluded that using principal reductions as a way to reduce payments and creating lower loan-to-value ratios provided more exit opportunities for consumers later on down the road and might provide more motivation. Obviously, under the HAMP program, constructed as the way it is an option. However, the industry standard now, most servicers are not using the principal reduction component of that. They're using the principal forbearance part of that. Investors, or the ASF, as well as several other entities have I think, been comfortable with that, and you'll see most servicers executing within those broad parameters.
Any other, the bank servicers
Sure,
have a
sure.
view?
I'd be happy to address that. Bank of America's perspective is that in certain circumstances, principal reduction makes sense. I mentioned earlier that we've done 190,000 modifications outside of MHA this year. Under MHA, the centerpiece of our activity today, 81,000 loans in trial, what we have found, it's not really the exit strategy as much as keeping our borrowers in their homes. And we found that rate reductions, we found that forbearance, we found that extension of term, those are the ways that we can keep borrowers in their homes, and that's what's important in communities.
So even though the affordability may be the same, I think is your rationale that the motivation to sustain that when we look at redefault rates down the road, that may have a
Absolutely. That's what led us down that road. When I said exit, what I meant there was that the borrower then has an opportunity if he needs to sell the house in 2 years or 3 years, or if he gets transferred. You're not carrying a balance that is unsustainable at that point in time. That's what led to that conclusion back at that point in time.
Appreciate that.
Yes, sir.
All right, my time is out. Mr. Atkins.
Thanks. I wanted to, Dr. Willen and you all wanted to refocus on the redefault aspect here, and especially with unemployment statistics as they are. The OCC and OTS had a study that they also released earlier this year, which pretty much dovetails with what you were talking about, Dr. Willen. So I was wondering, is this principal reduction really the only type of ultimate tool, or what are the other types of things that make sense in this context?
So on the issue of principal reduction, so this is exactly right. I mean, what I said before is, and the problem with negative equity is basically the borrowers can't respond to life events. And I think, I don't know if it's quite the right way to put it, but it's sort of like they don't have an immune system. So there are shocks that happen to people with positive equity that never show up in the data as foreclosures. They just show up as sales. So for example, in Massachusetts in 2001, we had a big increase in unemployment. We had a bad recession. The number of delinquent borrowers went up, doubled. But then you actually saw a reduction in the number of foreclosures. It was a record low for foreclosures. So when people have positive equity, there are lots of different ways. They can refinance, they can sell, they can get out of the transaction. So in the long run, I mean, I think one of the things we've been emphasizing is that it's not just the redefaults, it's the fact that there are a lot of borrowers out there who are okay right now, who are fine right now, and who may be fine a year from now. But until they build up some equity in their house, those are at-risk homeowners. And so in that sense, dealing with the principal reduction has its virtues. And the problem is that most homeowners with negative equity continue making their mortgage payments. And so you run this risk when you start reducing principal that you're inviting all kinds of people who can make their mortgage payments and who do make their mortgage payments to look for relief.
Right, and I guess basically, I mean, that's for the rest of you. I mean, I think that once we go down that road, whether it be cram down or whatever, we're basically changing the whole risk-reward ratio of this entire industry. And I was wondering what you how you would expect that to affect interest rates for everybody and the whole way that investors look at this industry.
I certainly would agree with much of what Dr. Willen said and would cite as an example negative equity around payment option arms. And that certainly is an area, product-based, where principal reduction makes a lot of sense. A program that existed a couple of years ago, but we eliminated that program. So payment option arms, prospectively, we will not offer. As it relates to improvements to MHA around these same types of issues, keeping borrowers in their homes, we've made suggestions and have had a good dialogue around what can we do for those who are temporarily unemployed, and how can we help borrowers, our borrowers, stay in their home as they go through a gap in unemployment, but we predict that they will gain reemployment. So there are opportunities there for us to keep working with our borrowers and keep them in homes.
Regarding in-principle curtailments, we do at Wells Fargo, depending on the product type, but like on pay option arms, certainly it may make sense to actually utilize curtailment just because of the dynamics of the product itself. But when you're looking at really the backbone of what we're trying to accomplish, one is addressing a hardship a customer is facing and trying to create affordability. To get to affordability, you can get there quicker and deeper through rate reduction, term extension, and really the top of the waterfall for HAMP. And that's really the approach we've been taking given the government's plan.
Okay, quickly, the part of the bubble produced a lot of questions regarding documentation, and now we see that come up in some courts and ownership issues. Who owns the mortgage? Have you all experienced that as a problem?
No. I mean, from a practical perspective, day to day, I'm not saying that there's never documentation issues, but in terms of being able to demonstrate who the owner of the mortgage is, that has not been a issue that.
Yeah, I would agree.
Okay.
I would agree as well.
Great. Okay. Thanks.
Yes, sir.
Great, thank you. Like my fellow panelists, I want to express my appreciation to all of you for coming and being with us today. A person might wonder whether this would be a pleasant experience, and you know, I want to commend you for being here. Dr. Willen, I think his testimony stated that we really needed to do something directly to deal with the consequences of unemployment, and that I think it's been the theme today that that's not in the design of the original MHA program. Do the rest of you agree that that would be a good idea for the administration to address that problem directly in the MHA?
We do at Wells Fargo. We've had a number of conversations with the administration around a short-term HAMP solution to specifically address unemployment and even underemployment when you can't create affordability based on that underemployment status. So we do.
Is Pennsylvania a good model for how to do this? The longstanding Pennsylvania program, it's been in effect for about 20 years.
I'm not.
With regard to the Act 6 and the Act 91,
I forgot the acronym.
Yeah.
The HEMAP. Is that program a good model for the Treasury to consider, in your view?
I think we will continue to look for innovations, and that is one that ought to be considered. I go back to the earlier comments, Mr. Silvers, that we need to continue to refine the program and work very strongly with the administration to keep our borrowers in their homes.
Thank you. Dr. Willen, you said a moment ago that in relation to principal reductions, that there was a problem of, everyone would like a principal reduction, not everyone needs one. Why is that not kind of a slam dunk argument, given the fact that principal reductions are, and I think everyone has said this, that there are circumstances in which principal reductions are the only solution, right? That principal reductions in commerce are typical, right? I mean, in other lending relationships, principal reductions happen all the time when people get in trouble in various ways. Dr. Willen, is the point that there needs to be some selectivity here, not just a slam dunk argument for putting this in the bankruptcy courts?
You know, the bankruptcy cram down, I don't know. That may well be. Let me say, you know, I'm no expert on this, but I do question how appealing it will be for a borrower who's facing foreclosure.
It's not an appealing place, is it?
No, and so it doesn't seem at this point like telling a borrower, hey, I got great news for you, you can file for bankruptcy. that's
But-
the kind of solution that we're looking for right now. And I just to
But
say,
isn't that a good thing in a way? I mean, if we want people who really want to
Yes,
stay in their
I
homes
agree, yes.
to pay a price, right? Not
Yes.
not to.
well, I mean, let me say, I think another alternative to this is an enhanced short sale program. Because in a sense, a short sale is a principal reduction. So I would, I guess, in this sense, I would
Yeah,
direct the questions to Larry in a way about
But that doesn't keep
what's
anybody.
happening with TARP.
That doesn't keep anybody in their homes. The short sale
It
program.
doesn't keep anyone in their homes, but it's an exit strategy for borrowers. And I think in some cases what borrowers are looking for is closure. And I think one thing to keep in mind, a lot of times borrowers now, and one of the problems they face is that they're unemployed and they have a job opportunity and they need to move.
That's a different.
And I mean, but these are the kinds
right.
of problems, when you talk to people, these are the kinds of problems
Well, I
they
think
face.
you've got different. I mean, I think that this seems to me to be the argument for having this option available, is that you have there, as I think your testimony quite compellingly states, certain types of life problems, such as needing to move for a job, being underwater is very, very problematic, and this helps. If you don't want to move, short sales aren't a big help, and short sales put a lot of inventory on the market, and that may not be what we want to do right now. But in any case, I just wanted to get that clear on the bankruptcy court issue. Mr. Litton.
Yes, sir.
We heard from Dr. Willen that his economic financial model, I think it's a better way of putting it, his financial model, driven, I think, by two numbers, redefault rates and cure rates, suggests that it may not be profitable for people in your position to restructure loans. You've just finished telling us that even before MHA, you have restructured, I think, something like 80,000 loans in total when you added all the numbers up?
Yes, sir.
You seem like a bottom line focused type of person.
Yes, sir.
Explain to me why Dr. Willen is wrong.
Well, there's I wouldn't say it that way that he's wrong.
Well, that's my privilege.
So
you
he's
can
a doctor,
be polite.
I'm not. So the way I would phrase it is this: is that in Litton Loan Servicing is typically under our prior ownership, we were aligned with the holder of the credit risk. Okay, so as loans defaulted and as losses mounted, it was in our best interest for those guys in order to modify the loans, keep people in their homes because the losses would be lower. That's number one. Then number two, what I would argue is that it's clearly stated in the pooling and servicing agreements that we all are kind of responsible for servicing loans under, that we have a contractual responsibility to represent investors and make losses as low as we can make them. And loan modifications, in our judgment, has been one of the ways to fulfill those contractual responsibilities. And then there are economic incentives way above and beyond what the HAMP program calls for. So, for example, advances. Anytime a borrower doesn't pay me, I have to write our company has to write the check and fund those advances to the investors. And in this kind of a climate, those advances add up to a lot of money at the end of the day. So all those things combined is what I would argue is what led us down this road.
I'll come back to this one.
Yes,
It's
sir. Yes,
far
sir.
expired.
Yes, sir.
During the prior panel, a statement was made that the incentives under the HAMP program were not enough to overcome the culture, systems, and other incentives that are provided to servicers. Do you agree with that statement, and would like to have a comment on it?
As Larry mentioned, we've been doing loan modifications for a long time, even pre-HAMP, because we do it because of fiduciary responsibilities to our investors. We also do it because we think it's the right thing to do for our customers. So regardless of the incentive structure, we think it's the right thing to do. Certainly, I want to go back to Larry's point around the cost of foreclosure. The advances made is significant. The reimbursement from investors doesn't happen until a foreclosure action is taken, or the loan reinstates through modification. So actually, we would recover monies sooner by doing a modification. So you would think the incentive structure is probably reverse of that, but certainly we're not incented to foreclose.
Mr. Jones, do you?
I agree with much of the remarks.
Okay. Mr. Litton, yeah? Do you, I mean,
yes, sir.
Do you think that was overstated, or?
Well, what I would say is that is the following: most servicers, or some servicers, and the reason that argument comes up is that some servicers have historically owned REO outsourcing firms or foreclosure trustee firms, things like that. And most of us don't. So it is not a profit center, I can tell you, in any way, shape, or form in our company and for most of the guys in the industry today. Yes, sir.
Thank you.
Yes, sir.
I'd also like to understand, and I've asked other panel the other panelists about recommendations for changes in the program design or in the implementation that would improve the process under which you comply with this program. Are there any that you would like to highlight for our panel in our work?
What I'd like to offer is, number one, a thought around the value of uniformity for all of us here. MHA offers that uniformity. As far as improvements, we certainly have
Meaning web portal documentation, is this?
We are a strong supporter of that and have been engaged in dialogues around that. So that is very helpful. Documentation is one thing, but again, there's a segment of borrowers that MHA is not able to help today. And so our efforts in discussing the unemployment issue is something that where we'll see definite value and uptick. But I'd like to look at MHA as one part of Bank of America's overall approach to keeping borrowers in their homes. And we support the administration going forward and want to continue the dialogue that has been very, very positive. We'll see things coming around second liens, around short sales, around deeds in lieu. As much as we can make those uniform, the better for the industry, the better for the borrower.
Thank you. Mr. Litton?
Yes, sir. I add one other thing that wasn't in my written testimony, which is I think more clarity around imminent default would be a great, great thing. We have lots of customers that are current that call us that need a loan modification, and you're right, it is absolutely silly to wait for the loan to go delinquent. I think HAMP does allow you to modify, but you got to have an imminent default standard, and having a little more clarity around that, I think, would make servicers more comfortable doing more loan modifications.
Good practical.
Yes, sir.
Suggestion. With my last 60 seconds, what I also asked the other panelists was to grade the servicers' performance, recognizing where we may be in this school year, using a grade of A to F. Since I am often used to being self-grading, and I often feel that we are probably toughest on ourselves in grading performance. I'd be interested if you would grade, you don't have to necessarily grade your own firm, but grade each other, or grade the man next to you. No, grade all the servicers as to in an A to F. I'd be curious.
Certainly, thank you for the question. I think this has been an evolutionary process where we get to where we are today. And in the beginning of the year, summer, I think we were really challenged. I think all the servicers would say we could do better, we could do more. Today, where we are, I would give Bank of America a B.
B. Mr. Litton?
I would comment more on from an industry perspective. I deal with a lot of people, whether it be up from the regulatory side, the advocacy side, our customers, et cetera. I would say our industry, given an honest self-grade right now, is at a C, versus where we need to be.
Thank you. Mr. Hoyer?
And I'll look at it from an industry perspective as well, and including the administration and everyone else putting this together. It's come a long way in 6 months.
And the grade is?
And I think the ability to kind of get to where we are is pretty good. So I would say a B.
Dr. Willen, you want to weigh in?
Well, just to weigh in that I think that if we're giving them a grade, we should take into account this. I think what we were trying to say, just to clarify a little, is I think this is an extremely hard problem. So this is like a grade in a Caltech astrophysics. And so I think, you know.
Great.
So I think they're doing well given what an exceedingly difficult challenge they have.
Thank you very much.
Oh, thank you. Yeah, I wanted to, some of the stories that we've heard today and elsewhere sounded like a lot of it has to do with training and internal processes, and it sounds like you all have increased the number of people, like it sounded like at B of A you have now 11,000 people, and at Wells Fargo 12,000. And so I was just wondering, what your efforts are to recruit, train, incentivize people, and then internal quality control is my question.
I'll start. So we had to adjust quickly, given the volume that came in pre-HAMP and post-HAMP. So as I mentioned earlier, we've increased staffing by about 4,600 team members in home retention just this year. And the training program is fairly comprehensive. It's from traditional training types, which is more classroom-based, but also very practical experience in working with our most seasoned representatives. And we'll actually rotate our representatives so that they're working with the skill set that they have. So less complex tasks are given to new staff. And then as they become more seasoned, we kind of rotate them into a more seasoned position. So I think between traditional and practical experience, it's what we've been doing with our staff. And we have an internal QC operation which listens to phone calls. So every one of our calls are actually voice recorded, and we sample that to make sure that what the customer is hearing is consistent with what we're actually putting forth. But it's been a difficult environment. I can tell you that. Just look at the HAMP program over the past 6 months. Things have evolved significantly, and it's been really important for us to make sure that our baseline employees understand what those changes are. So that's sort of how we've been doing it.
Mr. Atkins, I agree with a lot of what has been said around training. I would add that from Bank of America's perspective, the way we look at it, it really is top-down. So we have our executives are all focused on home retention, are all focused on how we train, the mention of call listening. We do that as a practice. We listen to calls, we critique them, and then we give them to the line, and we grade, here it is, here's where we need to make improvements. And it has been a process of bringing that 11,000 folks on board. It's not easy in astrophysics, as Dr. Whelan said, but it is something that we have gotten better at each month. And with the commitment of our leadership across the board, I think that the focus and the urgency around making these programs successful ultimately will win.
And then as far as incentives for representatives to, for themselves to show personal success, what sort of motivation is there internally as far as benchmarks, how they're themselves graded?
We have a standard package for our staff that are working, and we do not compensate on an incentive basis by X number of calls, this number of outcomes. So we have a base salary that we offer to our staff, and we have across the board for all employees of Bank of America pay for performance reward depending on how the company does.
Consistent with you all?
Yeah, I would agree. There's team member kind of report cards. There's group goals that we meet, and there's investor scorecards as well that we have that's directly tied to their status. So I think a combination of those report cards is how we really grade how effectively we're doing.
And then what I would add, Mr. Atkins, is that we've since HAMP's come out, we've really enhanced our quality control focus as it relates to that. I listen to phone calls, I talk to customers, I deal with the advocacy groups. I do, understand that there's frustration around, customers as it relates to, making sure that we have a consistent theme and message coming out from our employee base that is fundamentally critical. So we want to make sure incentives are aligned to accomplish that objective at the end of the day.
Okay, great. Thank you.
Yes, sir.
Mr. Silvers, and this will be our last round of questions. Our last question.
I think then we hear from the crowd. I want to get a couple things about data straight. Mr. Jones and Mr. O'Han, you both gave totals for temporary mods offered, temporary mods entered into. Are these totals for at the holding company level, or are these for your primary banking subsidiary? Mr. Jones?
The trial modification number that I gave you of 81,000 is for Bank of America.
Bank of America, the national bank, not for all subsidiaries of the holding company.
This is for all of the operations of Bank of America, which for all intents and purposes is the legacy Countrywide company and Bank of America that rolls up to Bank of America National Association.
Okay, there is, I was told that Bank of America, the parent, owns a firm called Home Loan Services. Is that correct?
That is correct.
All right. Can you explain to me why it is that Home Loan Services has zeros on the Treasury Department charts?
Sure. I'd be happy to do that. And
by the let me also say that there have been some other statements made about Bank of America by prior witnesses. I would invite you to respond to those as well if you wish, either now or in writing.
Sure. I'd rather go to.
But answer that.
Okay.
Yeah.
As we have acquired entities, as Bank of America has had the opportunity to acquire firms, Wilshire, Home Loan Services, the transition and the technology and the platforms associated with those companies have come into our system. So the number that I gave you is 81,000. I saw the zero for HLS.
Right.
Certainly understand and would expect that you would ask that question. We are working with our most at-risk borrowers and doing everything that we can to get trial modification started. So I think when you look at going from 28,000 to 81,000 today, the trajectory is very good, and that will continue for all of Bank of America.
Okay. Well, I would invite you, Mr. Jones, I don't want to spend all of the time we have on these matters. I would invite you in writing to comment to the panel on,
sure,
prior testimony relating to the Bank of America. I also, frankly, I don't understand zeros. I understand differentials. I don't understand zeros. If you want to expand more in writing on that, I'd appreciate it.
Sure.
Mr. O'Hayan, a similar question to you. Are there subs of Wells Fargo's parent that I need to know about that are behaving differently than the numbers you just described?
I think Wachovia is actually separated out in the Treasury report. So
right.
the numbers I described are part of the Wells Fargo Home Mortgage umbrella, right, which includes loans that we originated directly or those that we acquired the servicing.
Right.
But it's that umbrella itself.
Right.
It's not. It doesn't include like corporate trusts, so things where we're trustee, not direct.
Right. And does it include Wachovia mortgages that you now the Wachovia servicing?
I don't think so.
Because I think again we have an issue here where the Wachovia numbers are really not so good. And again, if you could try to explain that,
sure,
why that's so, since that would apparently be a pool of mortgages that really needs help, that would be.
Yeah. We certainly will. And a big chunk of the Wachovia portfolio that we service is the pay option ARM portfolio.
Right.
As I mentioned, the need for a solution on the pay option ARM portfolio for HAMP.
We heard you on that, and that was very helpful testimony to educate us on that subject. I want to come back to you, Mr. O'Hayan, one more time. Wells has a large, I believe, portfolio of second mortgages held in-house. Is that right? Not laid off on the securitized markets?
We do.
Can you just give me a dollar value of that, a number of loans?
I believe it's $129 billion.
Right.
Portfolio size for between junior liens as well as the equity lines that we have out there.
Right.
I can't give you a loan count. I apologize.
That's all right. That gives us some dimensions. What are the circumstances in terms in that portfolio in terms of 60-day no payments, foreclosures arising out of that? Do you know?
I don't, and I apologize. I don't directly manage the home equity group.
I would appreciate it if you could respond in writing, giving us that data on that book, and also the face value of that book, and also what it's carried at.
Absolutely.
Thank you. Am I out? I'm out. All right. Thank you very much.
Great. All right. Well, I very much like again to thank this panel As I said for earlier panels, this is not a one-time. We hope that you continue to have this level of dialogue with us. I know we've been in contact with you previously to this public hearing, and I look forward to continuing this level of cooperation with your organization. So thank you again, and you may leave. Thank you very much.
Thank you.
And now we're going to try to take as many questions or comments from, not questions, really this is an opportunity to, this is an opportunity for members of the public who would like to share any comments with us that we can take away with us. We would not like to engage, and it wouldn't be appropriate for us to engage in a dialogue or of answering any questions, but it is an opportunity for anybody to make a statement. We'd like you to try to keep that to a minute.
I'll be much briefer. My name is Lance Haver. I would encourage you, as you do your analysis, to think about people like me. I pay my mortgage, but my house becomes worth less and less as mortgage companies, which I'm forced to support through my tax dollars, refuse to do the workouts. And I encourage you to explain to other homeowners why it's so important that you force these mortgage companies, or you come up with the money necessary to help unemployed people pay their mortgages, that you help other homeowners understand that every time a house is foreclosed, their neighbor's house is foreclosed, the house across the street is foreclosed, the value of their house goes down. And frankly, living in Philadelphia with 2 houses on my block that are vacant, it will be almost impossible for me to sell my house now at the price that I think I would have gotten 2 years ago. If the mortgage company would have helped those families out and those houses were occupied, I would be able to sell my house for what it was worth. Thank you.
Thank you. Any other comments? Well, thank you all. We very much appreciated being here. I think this was a very constructive hearing for the panel and for those who are listening or who will read about this in the future. So I thank everybody who participated here. I also want to thank members of the public who were here for their time and patience. And again, appreciate the efforts of the staff that helped put this together, as well as the hospitality of the City of Philadelphia and others who contributed to this event. Thank you very much. Meeting is adjourned.